start off slow here to make sure that I don't lose my voice in this whole process going through here. But I have everything set up, ready to go. I've got two iPads, one I'm going to be drawing on today, trying to do a little bit of a whiteboard thing. Also have official Option Alpha cups and mugs ready to go for us today. It's going to be a fun day. It's going to be a fun day. I think you guys are going to enjoy it. A couple little housekeeping items. If you are watching this on recording later on, don't fast forward through everything. Try to get as much of it as you possibly can. We're going to be going through a lot of things today on day one for the next couple hours. And then what we're going to be doing is we're going to be jumping into tomorrow on Thursday, more of the bot building stuff. So how do you put together bots? How do you build automations? How do you use the different strategies? That's going to be the focus for tomorrow. And then the next day on Friday, so not tomorrow, but the next day on Friday, we're going to be doing like more bot stuff at a higher level. So like how do you build bot combinations together? How do you put different combinations of bots and portfolios together? How do I think strategically about putting all these automations together? And I personally think that you guys are going to enjoy that particular session. Really, if you go through all of these, you'll enjoy that one the most because it's something that we've never been able to do, essentially. So we've never been able to get to this point where we could take a strategy and run it start to finish and not have to, partition other strategies. Like this strategy has to come out so that that strategy can go in. So I think you guys are really going to enjoy it. Today's main focus, as I talked about previously, and as I'll go through here today, today's main focus is going over the following things. So let me just pull up this list here, and then you guys can see it. By the way, I'm going to try to be as nimble as I can with all the sharing stuff today. So please just bear with me as we continue to see if we can do as much of this as we possibly can. So, okay, so there you go. So that's basically what we're going to be sharing today. We're going to be going through all of this stuff on day one. This is, I think, going to be a really great high-level macro day for you, a day where you can come in and you can hopefully learn some of the big rock components of trading. That's my goal for you today. So as I kind of scripted this out and thought about this, I thought, okay, how do I get the high-level stuff for you guys? Can you guys see this, by the way? You guys can see this on the right-hand side of the screen. Just let me know here. Yep, there'll be a recording of it. We'll try to record this so you guys can get a copy of it, okay? I'm sure we'll have that question 200 times. Anyways, but so today this is going to be the focus. We're going to focus on this particular, kind of list, this list of what we're going to be going through here. The first thing that we're going to talk about is one of our new features called Smart Pricing. I think people flipped out over this the last time that we talked about it, so I don't want to bury it deep into today's webinar and the masterclass. I want to go through this right up front because I'm telling you, if you understand this new feature that we just rolled out, you're going to love it. People are literally flipping out about it, like cursing in emails to me, which is great. It's all good stuff. Like, this is bleeping amazing, right? The other thing that we're going to go through today is a lot of macro themes. So unicorn strategies, expectancy models, sequencing risk, trade duration, directional balance and laddering, position sizing, uncorrelated positions, which I'll show you guys a lot of research around that we've been doing. Broken models for fat tails and clustering and market memory. We're going to walk through kind of my Otis framework that we're going to be using as the basis for everything that we do moving forward on Option Alpha. Essentially is this Otis framework, which I've talked about for quite some time now. And I think if you understand it, and we're going to probably dive deeper into it than I've ever done before, I think that if you understand the concept around Otis and the infinity loop that we're going to be basically put on, it makes a lot of this a lot easier. It makes a lot of the trade up type of analogies that I use a lot easier to digest. Then we're going to be talking about binary decisions, steering wheels, and drag and drift and racing and stuff like that, which will be kind of cool. We'll be doing a lot of backtesting stuff today, so we'll jump into the new backtester, run some backtests, look at some backtests, manipulate some of the data, and kind of rerun some backtests with new parameters. I think you guys are going to really like it. And then I think the last thing that I'm going to try to follow up on, if we have some time here today, is the seemingly losing strategies that you can combine together. I think there's a big misconception that every strategy in and of itself has to be a great performer, but it may not necessarily be the case. I think if you can add some strategies together, you could take two seemingly losing strategies and combine them together and turn them into a profitable one. So does that sound good? Sound like a good framework for us to go through today? You guys pumped about this? I'm going to tell you right now, I usually get, and I am super pumped. I have to like almost peel myself back. I got to peel myself back for voice. I have my mic right here. I'm very afraid I'm going to lose my voice doing this today. So I hope that's not the case, but I'm going to try my best to just try to tone it down a little bit and just kind of talk softly and do this as much as we can. So, all right. So the first thing that I want to go through with you guys here today is I want to talk about smart pricing. And let me ask this question really quick. So if you guys are in here right now, if you're chatting, there's almost 200 of you across the different platforms right now. What I want you to do in here is I want you to answer this question as fast as possible, okay? So you have to answer this question as fast as humanly possible. If you see a bid-ask spread and you're trying to get into a position, if you see a bid-ask spread of 250 to 270, where do you place your order? Where do you place your order? 250 to 270, where do you place your order? You got to do it as fast as possible. Where's that first order go so you can try to get filled? I know there's a little bit of a delay in the comments, so I'll see all the comments coming in. But if you're at 250 to 270, that's the bid-ask spread, pretty wide spread. But where would you put your order to fill? Okay, this is exactly what I thought everyone was going to say. Mid, 260, 260. Someone said 269, 265, 263, 250. Okay, I know, assuming you wouldn't trade it. There's a lot of people who are like, I wouldn't trade it. Okay, I get it. And I understand that component of it. But everybody pretty much said this. This is pretty much what everybody said. This, right? This, 255. Where's some more? The 260s. Can you guys see this on the screen when I do this? 260s. Somewhere around here is probably about the average, right? Yeah, and I know. Some people are like, oh, I put it on a cheaper stock. I know, just play along here, right? But that's what people said, right? And I agree with you. I think that you're right. I think that because there's no alternative now, what do you do to get better pricing? You basically come in and you go, okay, how can I get better pricing? I got to manually do this whole process. I got to try at 260. What if I can't fill at 260? Do I fill someplace else, right? Do I, replace it and fill it someplace else? And I think that's the problem with a lot of this stuff right now is that they basically, you don't have the opportunity to do something different. Does that make sense? You don't have the opportunity to do something different. So here's how smart pricing works. We built this into the new platform, and I'm telling you, you guys are going to love it. What's going to happen is when you place an order through automated trading, you have the ability to use a function, a feature that we called, and we're submitting patents around this too, called smart pricing. And here's how smart pricing works. Can you guys see my screen okay? Let me turn it on. Sorry, apologies. There you go. Now you can see my screen. So this is how smart pricing works. Smart pricing essentially is an algorithm, and it's got some functionality in it that you have control over for how fast and how many increments. And I'll get to that here in a second. But essentially what we built and what will be available on the platform is the ability to use dynamic pricing and the firing of different orders, working your way through the bid-ask spread, right? Working your way through the bid-ask spread. So the problem is that when I said 250 to 270, most of you said 260, and I would agree. I would agree that that would be where that level is, right? I would agree that that would be the level where you would potentially want to place a trade. But what if you could get better pricing? So what smart pricing does is smart pricing actually fires through all of the different pricing. Let me actually just make this bigger. Smart pricing fires through all of the different pricing parameters that you would set. And in this case, let's say you're working up the bid-ask spread chain, it would fire orders at $3 or 3 cent increments every 10 seconds to see if there's a better opportunity to get filled. Now, a lot of people might do this themselves intuitively. You might try an order, cancel, try an order, cancel. But do you see how ridiculous it is that we do this over and over and over again, right? And there's no way you could possibly do this for every position, on every entry, on every exit, but now you can with smart pricing. Someone said they actually do this now, but yeah, the algo would be great for that, right? That's what it does. Okay, that's what it does. Hold on a second. We already got people in here spamming the group. Spamming the chat. 1 second. Let's see if I can make you Rocco. Rocco, where are you in here? You want to add your... There you go. Thanks, man. There you go. Now you're a moderator, so you can take care of that. All right, cool. You know what I hate is when you get like people in there that are doing the, what was happening is somebody was coming in like, oh, if you send me your email address, then I'll send you all this stuff. Right. But anyway, so someone said, can you do this on Thinkorswim? Now you can't. No, you'd have to manually do all the orders. So in this case, what smart pricing does is it works up the bid-ask spread chain. It fires an order at 250. It fires an order at 253. Then it waits 10 seconds. Then it fires another order at 256. And if there's a possibility to fill, of course, you could fill. And I think this is what's going to happen. I think that most of the time, not all the time, most of the time, there's probably a better fill price that you're just not trying. Does that make sense? That you're just not trying. And so at least what smart pricing does is it gives you that threshold to say, I'll work my way 60% through the spread. Like I'm willing to go to 262, 60% of the spread. And I want you to dynamically calculate the best intervals that I can work my way up and try better pricing first. Isn't that crazy that you could do that? So here's how it works in reverse. And by the way, these increments can be adjustable. So you could say if you're trying to get out of a position, you might be a little bit more willing to let the position stay and sit there for a while because now you're getting out of a position. So in this case, you could adjust the increments from a 3 second or 10 second increment to a reduction in price every 30 seconds. Does that make sense? It's pretty cool the way you can do it. And you can now allow the algorithm and the bots to make these really rapid fire orders down to as little as 3 seconds every time if you wanted to. Every 3 seconds, try a new price. If you're really aggressive and you don't want to wait and you just want to get in, but you still want to try better pricing, you could do it every 3 seconds. So the ability to use smart pricing, to me, is one of the ways that you just trump this whole discussion around. I think that people are wrongly focused solely on commissions. Not that commissions aren't great, and low commissions are definitely great. But if you lose a $5 bid-ask spread, but you save 30 cents on commissions, so what? Like, right? Is that really what you want to be focused on? And I have a hard time with that because I feel like a lot of people, what they do, and I'll be totally honest, they say, Kirk, I want to save 50 cents on commissions. But then they place all their orders really aggressive and they probably lose $4 to $5 per trade, per contract, just on spread. That's it, just on slippage that they didn't even know existed. Like it's water, money leaking out of your pocket that you didn't even know was going out of your pocket. And so that's why we built smart pricing. So you can turn on all of your bots to use smart pricing. You can use variations of smart pricing in the beginning when you enter a trade and then use a different version when you exit a trade. And you can dynamically trade with all this so that maybe you want to get in really aggressive and when you get out, you want to be uber conservative. And you'll have some variables around there. This to me pays for the whole thing, essentially. I mean, like this one thing could eventually pay for the whole thing. That's very cool. Because at least it gives you an opportunity to try. Because if you don't try and you just try at 260, could have had a better price. Okay, is that cool? Sound good? Great new feature. Yeah, and you could split the order, but at least you could get filled even if it got filled partial along the way, then at least you got better pricing on it. Yep, at least you got better pricing on it. Yeah, every 3 seconds is the limit. And I mean, like every 1 second. Doesn't see, you'd work up the chain so fast because you got to change pricing. So hopefully you're trading stuff that's pretty narrow in spread anyway. And smart pricing calculates those differences for you. So it knows, hey, I got to work in penny increments, or I got to work in 2 penny or 5 cent increments. Like some of the larger products only go in 5 cent increments, right? But at least it tries those pricing. It's better to try better pricing than the alternative. Very cool stuff. Okay, let's jump into it. I wanted to get that out of the way because I thought that was, not out of the way, but I thought that in and of itself, like hopefully pays for the whole thing. Does that make sense? I think it's valuable enough that it helps put you on the right side of scalping those trades versus being on the wrong side. But, oh yeah, you're saving 50 cents in commissions. Always blew my mind. So the first thing that I want to talk about here today, and this is the macro themes, and this kind of sets up a lot of things, by the way. So I'm just going to talk broadly about this as we start to go through this, if that's okay with you guys. First thing that I want to talk about is unicorn strategies. And I think it's a good starting point because, unfortunately, I think that people have the wrong assumption that there's one strategy that trumps all strategies. And if they were to just find that one strategy, then everything else would be cool, right? They would just find that one strategy and they would really, really, make a ton of money and they wouldn't have to do anything else. There's no mythical strategy that works, right? There's no mythical strategy that works in all environments, that works in every implied volatility range, that works in up and down markets, that works on ETFs and stocks, right? It doesn't even exist. And so we're delusional if we think that strategy exists and we try to go after it. So if we know that strategy doesn't exist, what is the alternative? Right? What's the alternative? Like, how should we mentally prepare ourselves coming into the markets as traders? Holy Jesus, that tea is so hot. How should we prepare ourselves as traders coming in? Should we just go after the strategies that have the highest ROI? Should we just go after the strategies that have the lowest drawdowns or the highest P&L per trade? Should we always use technicals or sometimes use technicals? Should we always use macro indicators or sometimes use macro indicators? I think the answer to this question, to me, generally, when you start thinking about strategies and how we build out portfolios, is we want to build out portfolios that have a positive expected outcome. I think if I could summarize it down into the most basic, if there was one building block of what we were doing, and what we try to do as investors is we try to build strategies and combinations of strategies that have a positive expected outcome. And that doesn't mean that we know exactly what the future will hold for us, because we don't, right? We have no idea what the future will hold for us. But if we can work in the context of figuring out what a positive expected outcome would be, at least we're pointed in the right direction. We give ourselves the best possibility of profiting compared to anything else, definitely compared to hunch. And there was a really cool little story around this that I thought was great. And I'll tell it right here because I think it kind of proves the point around this. But, and I forget who it was. Somebody can even, I think it was John Maddox or Tom Glavine, one of the two. Atlanta Braves pitcher. I truly forget who it was, if it was Tom Glavine or John Maddox. But he basically came off of a game where he had an amazing game. And he walked off the field and the reporter asked him, and they said, "How'd you do?" Now, we all know how he did, right? He did amazing. It was an amazing game. But his response literally has never left me. It's a fascinating response. And his response was to the reporter 78-73. And she's like, what are you talking about? He's like, that's how I did. 73-78. That was his response. And the reason that he answered the question that way was because 73 out of 78 times, he threw the ball where he wanted to throw it. It came off of his hand the way he wanted it to come off of his hand. 73 out of 78 times. And she asked him, and she goes, well, like, what does that matter? Because he said, after the ball leaves my hand, I have no control. I can't control what the batter does. I can't control if the ump calls it a strike or a ball. Like, I have no control over this. Once it leaves your hand, you're done. You have no control. And that to me has always stuck with me with trading, because once we place our trades, we can do everything possible to set ourselves up for success. But once we place the trade, we have no control over the market, right? Like, I know a lot of people think they have control over what Trump or Biden or anybody does and what the market's reaction is to that, but you don't. You don't know for sure. We don't know what the reaction is. We don't know if it's baked in or if it's not baked in. Does the market think so-and-so is going to win, or is the market going to be surprised at? The only thing we have control over is what happens when the trade comes out of our hand. We only have control over our positions. We only have control over our tickers that we choose, the strategies, our allocations, the framework around how we get into a trade. That's what we have control over. Does that make sense? So if you come into the market, I believe, and you worry about the things that are out of your control, you'll never be in control. But if you come into the market and you control the things that are in your control, those other things will seem dramatically less important. And frankly, they are. They are. I'll get to one story when we get further into it using Tom Bazzo and his approach to allocation and position sizing, because there's a fascinating story on research they did around why what you choose to trade, frankly, has no major difference in performance compared to how you actually trade it. Does that resonate with anybody? Does that make sense? By the way, I'll make this blanket comment because I know people are asking questions. We'll do a lot of the software demo stuff at the end, and we'll do a lot of it tomorrow and the next day. Today is more of a high-level conceptual stuff that I think is really going to help out, okay? I think is really going to help out. So let me do this and let's talk about expectancy. I think this should help out tremendously. By the way, new Apple Pen for you guys, so I can try to write this down on the screen and you guys can see it. So give me a second to get this set up. I think you guys will really enjoy this side of it. Because expectancy and sequencing is so hard. So hard to do. All right, let's do this. Can you guys see this okay? Hello? Can you guys see that? Yeah? There's a little bit of a delay. Let me do this. There we go. Can you guys see it now? This is just that little tough point. See some guy drinking coffee. There we go. Can you guys see this now? Yeah, you can hear me too. Hello, hello. Great. Okay, good. So hopefully this works. Like I said, I was just trying to mess with all this stuff for you guys. This is the only way I can figure out how to get it to work, but I think it does work for you guys. Okay, good. And you guys can hear me okay. So here's what we need to do with expectancy. And I think this is really the tough part about expectancy models is expectancy models basically work like this. And just to give you some context, they work like this. Let's say you have a coin, and let's say it's a 50-50 coin for heads and for tails, right? Somebody said, what are you drinking? Tea. Drinking tea. So it's a 50-50 coin for heads and tails, which means that effectively you hope 50% of the time is heads and 50% of the time is tails, right? Now I know this is very simplistic, but here's how I think about it, okay? 50% of the time you're hoping it lands on heads, 50% of the time it lands on tails. That would be a fair coin. Would you agree? That'd be a fair coin. So what happens if you were to bet on this coin? Let's say that when it's heads, you bet $1. And when it's tails, you lose $1.50. Right? Someone said, I thought I was the only one that made fives like that. So that's it. That's your bet. Now, you know intuitively, is this a good bet or is this a bad bet? 50% of the time, if this coin is in fact a true coin where it's going to land 50% of the time heads, 50% of the time tails, it's a bad bet, right? Super bad. Super bad bet. Because you have negative expectancy. Because 50% of the time you make $1 and 50% of the time you lose $1.50, it's a terrible long-term trade. Would you guys agree? Now, this is all stuff that you guys haven't been told before. You haven't been told this before. Like you've been told this before. This isn't something you haven't been told before. You know this. But here's why this is a really great model to start with. Because when you start trading, and let's say this is day one, you're going to have a series of heads right in a row. Now remember, you're still trading a 50-50 coin flip. And you're still trading a system that has a negative expected outcome. Remember, the end result all the way down here is you should lose on average 50 cents on every trade. On average. But the first couple of days, you're making money. You make $1, $1, $1, $1, $1. You can use this in whatever framework you want. Okay, by the way, it's not the first couple days. Say it's the first couple months. Say it's the first couple years even. You could be running a system that eventually will run you into the ground, but it could look amazing for 3 days, 3 weeks, 3 months, or 3 years. But you know when you get here, it's not going to go well. Right? So the problem with expectancy models is that one, let me say this. The problem with expectancy models is two things. One, we have to find them. That's the first problem. The first problem that we have with high expectancy models is we have to find them. Like, where do they exist? How do we find them? How do we find things that actually work or that should work moving forward? Agree? That's probably the biggest. This, to me, by the way, is the root of all the questions we get on ideas. So everyone emails in, they're like, I don't know any trade ideas. Right? That's where it is. You have to find them. That's problem number one. Problem number two is trading through sequencing. I know my handwriting is terrible. But problem number two is trading through the bad sequences of ups and downs. Right? Because even in our coin flip example, erase this, we have our coins, we have heads, and we have tails. We could go through a series of a ton of heads, and we could go through a series of a ton of tails right in a row. And the problem is we have to trade through that sequence of returns, which could be really low. It could be a high sequence. You could run a sequence of returns that are really good. Like you're just crushing it and killing it for a number of months. But then you go into a downturn in your trading, and it has nothing to do with the coin itself. Right? Doesn't mean that the coin is broken or bad or flawed. It just means that you just ran through a sequence of tails or a sequence of heads. So everything I'm going to show you today, when we start getting into the backtester and how we now show performance of strategies and how we can run performance and strategies right inside of Option Alpha, a lot of these numbers are there to give you context, right? A lot of these numbers are there to give you context. Does that make sense so far? So we have to go after those strategies that have high expectancy. And we can't be dissuaded by the whole illusion of control that we have. We have no control over what we do other than what we get into. So here's the next thing that we're going to go through. Trade duration. Trade duration. So the first thing that we have to talk about when we talk about trading is we have to talk about duration. And I think that duration is important to understand, because what duration tells us is it tells us how long we're in trades. And that becomes a function of how many times we have to trade. Would you guys agree so far? So when we talk about trade duration, let me just write this out. Whoops. Where'd it go? One second. I got to restart this little thing here. Okay. You guys should be able to see this now. You guys see the screen here? So when we talk about trade duration, we're basically answering two things. One, how far out long do I stay in? That's the two main things when it comes to trade duration. Now, by the way, trade duration should not necessarily be the only thing that you think about. So I'll ask this question into the community right now, because I think this is a good one. Would you classify yourself as a long-term, medium-term, or short-term trader? Right? Would you classify yourself as long-term, short-term, medium-term trader? How would you classify yourself? Short, medium, long, short? Right. John Fleming, I know you're short. Yep. Medium short, long short, blah, blah, blah. Right. There's two problems with this. One, the first problem is when you classify yourself as one type of trader, you immediately lose 50 IQ points because you box yourself into anything that could be something different. That's one. So you box yourself into ignoring effectively, subconsciously, anything that could be different than what you are used to already. The second thing is that duration is one component, and as long as the strategy works and has a positive expected outcome, what do you care how far out or how long you need to stay into it? What you're ultimately trying to do is optimize the strategies you're trading. If the most optimal, just to use a ridiculous extreme example, but if the most optimal strategy required you to be in a trade for 130 days and stay in it for 125 days, do that. Do that. But the problem I see it is that everyone forces themselves into the buckets of short-term, medium-term, long-term. They force themselves into trading one strategy or one type of strategy because that's how they classify themselves. So when it comes to duration on a timeline, let's say this is 0 days until expiration because we're all traders here. And let's say this is 30 days and 60 days. The time period that you're in a trade. So if you're in a trade starting at 60 days and you exit, say, at 25 days or 15 days, that could be one type of strategy. And that could be a strategy that's great to add to your portfolio. You also might want another strategy that only goes from 15 days down to expiration, a shorter duration strategy. That strategy may not be the end-all be-all strategy, but it might fit the bill for consistently having some aggressive, short-term, high theta type of position in your portfolio. And then you might have yet another strategy that goes the whole span of this and then all the way out to 90 days or something, a strategy that takes a long time to work and goes across the entire expiration spectrum. So when we think about duration, please do not think in such boxed in terms as short-term, long-term, medium-term trader. Think about how we can combine and layer different strategies together that span potentially different durational periods. Because when you do this, when you increase the frequency and duration of trades, you allow yourself to more quickly adjust to market dynamics and therefore reduce, I think, the volatility in your account. So what do I mean by this? You guys grabbed your screenshots of this? I know people are taking screenshots. Let me play devil's advocate for a second. This is January, and this is December. If you only traded one time per year, how important is that time? How important is that time? Let's say you only had one trade. You had one trade that could be 10 days. How important does that one trade become? It becomes everything. You either pick a great time here, or here, or here, but now you have boxed yourself into being extremely accurate in your market prediction for that very, very short period of time. So instead, what I want you to do is I want you to think about how you can layer different durational periods on top of one another. Now, I'm not saying that there's an answer to this. There's no mythical unicorn strategy that says, oh, you got to have a 10-day and then a 20-day and then a 60-day. But what I want you to do is I want you to think, how can I have a bunch of short-term trades if there's a positive expected outcome on those types of trades throughout the year? And how can I have some trades that maybe are a little bit longer term, 30 days, 60 days? How can I layer those on top of it? And how can I have some trades maybe that are 3 months or 6 months and layer those types of strategies on top of it? So that, yeah, if one or two of these strategies don't work out for a given period, they weren't everything. Does that concept make sense? It's a hard concept to kind of describe, and hopefully I'm drawing it out as well as I can. But when we talk about duration, it's not that you have to pigeonhole yourself into, I only trade 30 days or less. I want you to open your mind as we go through today to thinking about how you can layer strategies on top of one another. Does that help out? Let me know in the comments. Yeah, it's the idea around laddering. Laddering's another component of that too. Someone said hasn't crossed your mind. All right, good. So next thing that we have to talk about, and here's the thing, let me back up from this real quick and say this, okay? Let me take this screen share off. Here's one thing about it. Hi, I'm back. This pen needs to charge for 2 seconds. One thing you've never been able to do is you've never been able to scale your time with trading. I want to talk about this for a second because I mentioned this on a live stream the other night, and I think it's so critically important. You've never been able to scale your time with trading. So think about this, right? You have a fixed amount of time during the day. There's only so much time you have to trade. How much time do you have to trade during the day? I'm just looking in the comments right now. On a perfect day, how much time do you have to trade? If you're retired, don't answer. You got all day. Right? You don't have that much time to trade. So when you go to trade a strategy, so some people said 45 minutes, an hour, 1 hour, 1 hour, 15 minutes, 20 minutes. Look, so the problem with this is, thank you for answering. The problem with this is that because you're limited in time, you have to make choices on what strategies you choose to trade or not. Because everything's manual. Like, you can only dig so many holes per day, right? You can only dig so many holes per day. If you've got 15 minutes, that means you can't trade 20 different strategies. Do you agree? You can't trade 20 different strategies. 20 different, uniquely different strategies. Maybe short duration, different strategy, because they all have different rules, potentially. And you can't trade them all because you got 15, 20 minutes, an hour a day. So what auto trading allows you to do is it allows you to scale your time infinitely. Because all you have to do to trade a new strategy is figure out what that strategy is and what the parameters are once, and then automate it. Figure out what the strategy is, what the parameters are, what you want to do, and then automate it. So now if you want to add a new strategy to your portfolio, you don't have to kick something else out. Does that make sense? Like, if you want to add a new strategy to your portfolio, you don't have to stop trading something else because you're limited on time. Is that pretty cool? But think about the possibilities of doing this now. Now, maybe you never thought that you could trade a strategy that was 90 days in duration. Because trading a strategy that's 90 days from expiration that you have to wait on sucks. And it's not fun, and it's not really cool. It's not exciting, but you could add that to your portfolio. on the other side, if you have a strategy, maybe that's 10 days from expiration, and you think to yourself, man, I could never manage that type of strategy because I can't constantly check it every 10 days, that can be now added to your portfolio because you can auto trade it. So when we talk about duration, I know I'm really harping on this, but I feel like people have boxed themselves so much into this like area of choosing different durations. It's crippling to what you're trying to accomplish. All right, next one I want to go through here. Let me take myself off. We'll just do this one. There we go. Can you guys see this now? And we're back. So there she is. Cool. Thanks, Rocco. By the way, you can keep texting me all that stuff if you lose me. Love technology. So next thing that we have to talk about is directional balance. Oh man, that was really bad writing. I'll fix that for you guys. Directional balance. This is really, really, really cool. If you think about the market, and this is how I think about it, I think about it on very much a seesaw type of thing. If you think about all your positions that you're trading, and this gets to the heart of what people like to call neutral, delta neutral, beta neutral, whatever neutral terminology, they're a little bit different, but this gets to the heart of it. But directional balance, I think, is important. And I think that we should discuss this here for a little bit contextually because it is important as we move forward. You need to have positions that work when the market is bullish, positions that work when the market is bearish, and positions that work when the market is neutral. Would you guys agree? And we'll talk about correlations and all that stuff here soon. But you got to have both. You got to have all of these things. Now, here's where I think people mess up. I think people think it's a counting game. That's what people think it is. That's what I thought it was. But I think that's where people fail in this, is that it's not about counting how many trades you have to say, oh, I've got 3 bullish trades and I've got 3 bearish trades. Yes, that would be balanced as far as 3 bullish, 3 bearish. But instead, you need to think about the magnitude of the positions and either how much risk they take on or how much profit potential they have. So if you're thinking in bearish terms, you might have one bearish position that's like this. And when you're thinking in bullish terms, you might have 5 or 6 bullish positions, but the combination of them outweighs each other enough. Does that make sense? Is that a cool thought process? Now, when the market starts to tilt, this is the fun one. When the market starts to tilt, and let's say starts to become more bearish, so the market starts heading lower, right? The center of the, it starts to move to one side. The natural tendency for people all the time is to do what? Let me reset this and I'll draw a different way. The natural tendency is to do what? Markets are here, and then markets start to go like this. What do people do? They buy the dip, right? You ever heard that terminology? Buy the dip. Always shocked me. Or they panic. Yeah, or they panic or sell. But let's say that you have a neutral portfolio before this. So let's rewind the clock a little bit. Right here, you've sold some bullish positions, sold some bearish positions. Now you've got a portfolio that generally makes money between this range and this range. This is your break even. Break even 1. This is break even number 2. So if the market starts to head lower towards this break even, how do you get back to neutral? How do you get back to neutral? You trade bearish strategies. You effectively need to shift these break-even points lower, and the only way to do that is to trade bearish strategies. So as the market's going lower, what you don't want to do is you do not want to buy the market. It's literally the worst thing you can do, because what you end up doing is you end up digging yourself into a deeper and deeper and deeper hole. Ask the people who sold or who bought the market when it started to crash in March. And then it kept crashing and it kept crashing, and they kept buying and they kept buying and they kept buying, and then they just blew up. So what you want to do instead is that when the market is starting to head lower, you want to start trading more bearish strategies so that you can reset your break-even points to something like this. And now you're neutral again to the new market price. Okay, now JTRI, whoever that is in YouTube, asked a great question. And this really leads to the next part of this. So this is part 1. But he said, is it risking a whipsaw effect? And this is a great question. I'm going to hold off on it for 1 second, because once we get through this, that's the next part of this question. But does everyone understand so far here? And please just let me know. A bunch of yeses in here. We've got hundreds and hundreds of people in here, as many as you can. Like, does this make sense? When the market goes down, you trade directionally. You trade the direction of the trend. Right? Great. When the market goes up, you trade directionally the market higher. The market goes up against your generally neutral position that you've tried to build out, then you add more bullish positions. It's actually a very simple way to do it. So the problem is this, that somebody had. Let's say the market is doing this. That's the stock chart. We'd all wish it was that great. If you do this and you only do this neutral trading, and let's say you do it on a really, really small little time horizon, like you place a trade here, and that's your break even, and that's your break even. Can you guys see that on the screen? Hopefully you can. I know it's small. But this is your whole universe of trading, just right here. These guys, this one, and this one. Break even 1, break even 2. If you only were to place that one trade, and then the market went through your break-even points on either end, yeah, there's a risk that when you adjust down or adjust the position up, you're going to get whipsawed on that position. So how do you combat that? How do you combat the whipsaw effect of individual positions? Because this one position right here, that one position, depending on when you time the adjustment or not, you can get whipsawed. You make an adjustment that the market goes right back the other way against your position. And that sucks. So the way you combat it is this. You enter a position there. Then a couple days later, you add another position here when the market goes down. When the market goes back up, you add another position. When the market goes back down, you add another one. And it goes down again, you add another one. And then you just keep layering these positions one after another in small, frequent increments. By the way, I've been teaching this concept for a long time, like well before many of the other people started really jumping on it too. Not that they weren't already doing it, but this has been a trading concept for years. This is not like a new thing. But that's how you do it. That's how you break this run of being whipsawed by positions. Because the problem is that when you think that you're going to get whipsawed, you're thinking in too focused, your mindset is too focused on one particular position. Your mindset is too focused on one particular position. Your entire eyeballs are focused on this position instead of the totality of all the positions that you have. It literally drives me banana sandwich. Because when your mindset is focused on one position, what are you missing? And I talked about it right at the beginning of this demo. You're missing the expectancy. You're missing the big picture of what you're trying to accomplish. You're missing the expectancy of all the positions, not just one position that might go wrong. Yeah. So when you layer positions on top of one another, like this, you might have, I should have drawn this a little bit different here. These are all new positions, right? New positions. You might have a couple that go bad, but then you have a bunch of other ones that go well. And you don't care, or you shouldn't care as a trader. You shouldn't really give two craps about these ones or these ones for that fact. You shouldn't care about any of these individual trades. They're just trades. What you want to know is you want to know, after all of this trading, where do I end up? After all the ins and outs and rolls and adjustments and credits and debits and whatever, did I end up with a positive expected outcome or not? Would you guys agree? That's really what you care about. But for the most part, a lot of people, what they do is they focus all of their time and energy on, oh my God, that one trade that I had blew up. Yeah, someone said it's the recency bias, for sure. Rearing its ugly head. Now, here's why I think that auto trading is so amazing. And I'll just dovetail on this for a second. Because auto trading allows you to avoid this with bots. Auto trading allows you to avoid this with bots. Bots are so beautiful because what they allow you to do is focus on the whole system versus the individual trade that you don't need to focus on anymore. You don't. Because what do? You interject your emotions. You come in and you say, oh yeah, I wanted to get out of that position, but maybe it'll turn around. Right? I know you. I do it myself. I know myself too. You get into those positions and you're like, oh, maybe that'll turn around. What bots force you to do is they force you to think about the whole strategy in totality. It just by their nature. they force you to think about setting up systems that in totality should help you become more successful, more profitable as a trader. What manual trading does right now is manual trading forces you to confront every single trade in the sequence that they occur. And so if you have 5 trades that go bad in a row, you are forced to confront all 5 of those trades yourself every time. So what we should be doing as traders, to bring this back home a little bit, what we should be doing as traders is we should be laddering our trades over various durations. We should be laddering our trades over various durations. There's a terrible V here. I apologize to you. That V is off or that R is off. One of the two. So if you want to think about it this way, to use our timeline example again, if this is our timeline of trading, we have one 10-day trade that goes this duration, and then we stack another one, and another one on top, and another one, and another one, and we have a bunch of trades that are 30-day trades, and we stack those on top of one another, and we just stair-step all of these trades right inside of our bot portfolios. These become little bots that do all the work for you. Independent little trading strategies. Independent little trading strategies. And they cross over. Like this one starts trading within this strategy at the same time. But it doesn't matter that they're crossing over and they're trading at the same time, because guess what? You're not having to manage them. You focus on the big picture. You focus on the big picture of what we're doing. Does that work out? Is that helping so far? I just take a break here for a second just because I got to tell you guys, like, this concept to me, I think it's truly everything in how I think about it now. Just like the concept of duration shouldn't matter as much, right? You should ladder your trades. You got to ladder your trades. Like you can't pick and choose one trading day a year. It allows that day to have total control over you. You need to let the bots elevate your thinking so that you don't get drug into every position. Does that make sense? I think that's what's so beautiful about bots is that they force you to think now at this higher level. They force you to think in totality of the whole thing versus just, did I make money on this trade? You like the shirt? It's coming, don't worry. Jesus, that tea is still so hot. JS said, when you're talking about laddering, are you talking about laddering the same ticker? Yeah. Laddering the same ticker or the same series of tickers or the same strategy, just taking your frequency out and breaking it into more recent entries. So instead of 10 positions at a time, do 1 position per day. Does that make sense? That's the way you got to do it. This is a good one, and we'll get to this one here quick soon too, but Blake asked the question, any thoughts on how long of a look back to use for measuring a trend? Does it depend on time until expiration? I think there's a lot of different ways you can use it. And I don't think that it's a yes or no answer, right? Like, I think trend could be a scaling thing. So who has a good, Meb Faber uses this, a good example that he uses is that, let's say you buy a stock when it crosses the 50, then you buy another tranche when it crosses the 100-day, then you buy another tranche when it crosses the 200-day moving average, right? And then you could like scale out of that as well. Does that make sense? You could scale out of that as well. So that it doesn't have to be a one size fits all thing. Cool. Has this been good so far? This is kind of fun. I've never done this before. This has been super fun. Let's keep going. Next one I want to talk about is position sizing. Next one I want to talk about is position sizing. I don't know what better way to describe this than probably the one I hope would be this way. Let me get to my notes here so I can go through this. Because I think this will help. I think this will help. Okay. Let's make this one bigger. There we go. Should see this screen. Can you guys see the screen now again? So there's two concepts that I want to talk about with position sizing. Two concepts I want to talk about with position sizing. When it comes to position sizing, let's use our heads and tails example again. Our coin that was heads and tails. This is so important just to get the framework right. So important just to get the framework right. And if you know that there's a 50% chance of heads and a 50% chance of tails, and let's even say that when you won, when it was heads, you won $1, and when it was tails, you lost $1. So this is tails, and this is heads. The expected outcome of this model is 0. You guys agree? The expected outcome of this model is 0. So Martin asked a question. We just wanted to, he actually wants us to demonstrate it. We've done this in demos. You can join a demo or watch a demo, Martin. We're going to do a lot of the demoing tomorrow and the next day. Today is high level stuff, and we'll get to more of the back testing stuff in here today. Is that fair? We didn't say we were going to demo the platform here. We have an actual demo that we do. So the expected outcome of this model here is $0. You're really not going to make or lose any money, right? That's the idea. But here's the problem that people have. If you know that the expected outcome is 0 and you don't want to lose money, you just don't want to lose money, you have to trade every flip of the coin with a very, very small amount of capital. So you've got to take every flip of the coin, heads or tails, and maybe do, let's say your pot is $10,000. Maybe you just bet $1 every time. That's it. The smallest possible bet that you can make. Because if you get into a bad sequence of flips, let's say you get 25 tails in a row. Let's say you get 25 tails in a row. The expected outcome was not anywhere close to 25 tails in a row. You were hoping for maybe, 13 tails, 12 heads. That was the assumption. But if you run into a bad sequence of trades, again, not that the coin is broken or bad or whatever, you could easily start to lose some capital. In this case, you lost $25. Now, $25 is nothing when you do $1 at a time. But what would happen if instead of betting $1, you bet $500? What if every flip of the coin you bet $500 and you ran into the same sequence of tails 25 times in a row? You blew yourself up. Do you guys see that? The exact same expectancy model. 50% heads, 50% tails. When you over allocate, leads to you blowing yourself up completely. Now, I know you've probably seen this before. I know that I'm probably not the first person that's ever pointed this out. Maybe I am. But when it comes to position sizing, I cannot stress enough how much getting the right position size in place is for your portfolio. And the right position size, by the way, as we'll see here when we go through some of these backtesting examples, the right position size doesn't mean that it's always 1% or that it's always 2%. It could be different for different strategies. For strategy B that we run in our portfolio, we need 2% allocation because that is the better way to go about it. That's the one that's more stable for us. For strategy A that we run in our portfolio, we need 1% allocation position because it's maybe a little bit more of an aggressive strategy. And the beauty of what you guys will see today when I jump on and start doing the demo with the backtester and we start managing those adjustments between allocations is you get to pick and choose which one works better for you. So here's an example, okay? Let's do this. Strategy A has a win rate of 70% and a profit factor of 1.5. Strategy B has a win rate of 60%, but a profit factor of 1.75. Which one's better? Which one do you choose, A or B? You may not even have all the information enough to choose right now. Or neither. But now what if I introduce yet another metric and I say the drawdown on this strategy was at most 20% and the drawdown on this strategy was 75%. Isn't it fascinating how different allocations, and it could be completely the opposite too, by the way. It doesn't have to be this. It could have been completely flipped. But what I want you guys to get at is just understanding that the allocation that you select has a massive impact on the performance of the strategy. Massive, massive, massive performance on the strategy. And as long as you understand that, you should be better off in how you now look at new strategies inside the backtester. Because it's not just the win rate. It's not just the profit factor. It's a lot of different things combined together. Would you agree? And typically you find that the lower allocation strategies like 1, 2, 3, 4, 5% typically are just a little bit more stable. a little bit more stable. What you'll often find, and I'll show you this in the tester here too, is you'll often find that a strategy that, let's say, allocates 10%, just to be really extreme, will go through periods of this. Might end really profitable, but we'll go through pretty volatile periods, whereas a strategy of 5% might look like this and might not end as profitable. Now, I don't care which one is better for you, and I'm not here to say, yes, you got to do this one, or no, you got to do this one. But man, do you think that the function of the distribution of returns is important? Because you may not be able to survive a 20%, 30%, 40% drawdown. Now, here's a couple rules that I think are really cool. And this, by the way, I take no credit for this. I'm literally taking, I thought this was a really good presentation. So I take no credit for this by any stretch, okay? There's a great presentation by Tom Bazo. I don't know if I say it right. Bazo. Great presentation. And basically what he said was that many people look for the trigger, he calls it an engine, the trigger, and they focus all of their attention on the trigger, which is the buy or the sell indicator. Now, be honest now, if you're listening to this, watching this right now, how many of you spend your time mostly on the buy or the sell indicator? When you buy, when you sell. I buy when it's RSI below this, CCI below that. I buy when IV is high or this crosses that. Whatever that trigger is, how many of you truly and just honestly say that you spend, that's where your mind goes? Your mind goes to the trigger. And by the way, it's very natural. I do it too. Like, I always look for that point where we could say, this is when I get in, right? This is the when to get in point, or when to get out, alternatively. But here I thought was the best example of this, and this was so good. So just follow me on this for a second. When you only look at the buy or the sell trigger, it's like turning on a stove to cook. And if you just turn on the stove to cook, but you forget about the combinations and the order and the sequence of the ingredients that you're going to cook, how good do you think your meal is going to be? Because if you just focused on, does the stove have heat or not? Am I on or off? And that is the focus of your trading strategy, and you don't give enough attention to the other components, how good is your meal, aka your portfolio, going to be? And basically what they did, and I don't have all the details of the strategy and all that stuff, there's a lot in there. But basically what they did is they ran a bunch of strategies where they had random, look at this, completely random triggers. Completely random triggers. Made up in some cases. And they bought randomly, they sold randomly, they bought and then sold randomly. Sometimes they just bought randomly. Sometimes they sold randomly. Random triggers. But what they did, in addition to just randomizing the entries and exits, is they focused on the position size and the management of positions. And what he had said was that, and I thought this was awesome, he said that more important than the random triggers was position size, was getting this right and managing positions appropriately. Do you guys agree that that would be true, or do you not agree? It's okay. You can tell me honestly. Maybe you're like, that's crap. But he said more important than the triggers that you got into was actually your position size. Great position sizing was way more important than any random trigger they could have gotten into. That's fascinating if you think about it. And they tested on a bunch of different markets, ETFs, stocks, futures, commodities, all of it. Tons of different indicators. They just randomized everything. They said just randomly do something. Somebody said size does matter. Yep, it does. Okay. Here are some general guidelines that I think, these are kind of Kirk's general guidelines, but can I tell you guys this openly? Like, these are subject to change. This is my idea of what you should do, and this is just a guideline. This is just a guideline, and if we see new research, and I reserve the right to change this. I think that 50% in cash is a good starting point. I just don't know. We haven't seen many strategies where investing 50% starts to improve the performance, like more than 50%. Remember, options are leveraged. They're a leveraged product. They have built-in leverage. You're driving supercar financial products here. You just don't need that much leverage. And then I think when it comes to tickers, I'm of the opinion that you should be around 5% for every ticker, which that 5% could be split into 10 different allocations of 0.5% apiece. And then when it comes to individual positions, I think you keep those positions as small as possible so that you can do 0.5%, 1%, 0.25% per position. Because if you do 0.5% here, 0.5% here, and these are spread out day 1, day 3, day 4. Do you guys get the picture? That's how I think about it. Some quick notes from Bazo, the way he looks at it. If you do it based on some metrics like volatility, it could be around 50%, sorry, not 50%, 50 basis points for a position. Based on some average true ranges of volatility and some calculations of position size around that. That's one way you could do it too. So if volatility is really high, you naturally scale back your position size appropriately. We'll have lots of training on this type of stuff too in the new website, but I'm trying to go through the high level stuff. Another way that you could do it is based on risk, which is how I do it as well. Risk is definitely less than 5%. So whatever the total risk of a position, that risk has to be less than 5% of the full portfolio, the full portfolio value. And remember, that position sizes can grow a little bit if you want them to. They're not fixed at 1%. You could have a sliding scale between 5% and 1%, where you could say these trades are low IV positions and these ones are high IV positions. So when there's high implied volatility, I'll scale up, and when there's low implied volatility, I'll scale down. Now, again, when we get into the backtester here very soon, we can start looking at some of this stuff and start saying, okay, maybe this is the type of strategy that I include 5%. Maybe this is the type of strategy that I include 1%. Does that help out? Allocating 5%, 1%. Why not invest in more and fewer companies? Because we don't care about the companies here. We don't care if the company does whatever. We're just trading. We're trading the options or the products around it. Now, if you want to do your own due diligence and you still love them, I still think you should keep your allocations low just in case you're wrong. A lot of companies that had great 5-year, 10-year projections got smashed this year when the coronavirus hit and the pandemic hit. Do you guys agree? All the companies that had great projections completely got their world turned upside down in a black swan event. So if you do your own due diligence, that's fine. Just be ready to change that. I personally don't care. I don't care. The timeline that we're generally trading on 30, 60, 90 days is so short of a timeline, anything can happen, and frankly, long-term valuation doesn't matter that much. It's just market movement. Okay? You guys want to get into some other stuff? Has this been helpful so far? Holy cow, we're already an hour and a half in. That's a good question. Paul says it's safe to assume your platform will allow allocation at total percentage and per contract. You just have to type in that dollar amount. Right now, we don't allow you to do it based on percentage. We want you to actually physically type in the dollar amount. So if you have $100,000 and you want to allocate 25%, you have to physically tell the bot to trade $25,000. Yep, is that cool? All right, let me show you guys some different stuff. This is another component of it. Ooh, you guys are going to like this a lot. Let me get it ready. I can't even show you that first. Let me see here. I gotta show you something different. This I think is really fun. This is really fun. Let me get rid of this one and we'll share a different screen here. Okay. You guys see this now? This is Hercules, the Hercules file. And this is for uncorrelated calculations. Wait. Now you see it. There it is. Ha, I was just joking. I'm getting the hang of this platform here. There we go. So the next thing that we have to talk about is correlations. So man, we've really hit man, women, boys, girls, everybody. We've really hit a lot of different areas in frankly a pretty short period of time. We've talked about sequencing, we've talked about trade duration, we've talked about directional bias, expectancy models, position sizing. A lot of this is going to continue to come back around as we start to do back testing. But one thing that we haven't talked about yet is diversity of tickers. And I really believe this is a very important thing that most people frankly overlook, gloss over. And I know this is the case because I see all the groups and the forums and the threads where people are just trading 4 or 5 different things. And unfortunately, it seems like 5 highly related tech names in some cases, right? You've done that before. You only trade Tesla and Facebook or whatever. What I at least want you to start thinking about, and I'm not going to try to impose my thought process on you. I want you to start thinking about how can we start to get the benefit of uncorrelated securities. Uncorrelated securities. And I think the problem with when you get into this idea of strategy diversification, what a lot of people think is that strategy diversification means that you have to lose on something to win on the other. And that's not the case all the time. It's not the case that you have to lose on something to win on the other. It could be that the distribution of returns don't overlap each other, and that's a good thing. Right? One strategy could, you're not going to make money in an up market, but you might make money in a down market, and the distribution of returns could be different overlapping periods. But the problem with diversification is that it does guarantee that we'll pretty much be wrong on something throughout the year. Here's the funny one. Okay, let me take this off for a second. The funny part about diversification is you are willingly getting into trades you know that you're probably going to lose on at some point. It won't always be that you have to lose on one to win on the other, but you're willingly getting into trades that you know you're going to lose on at some point. And that mentally is tough. That's why people try to focus their positions. And they try to think that they can pick and choose the 5 or 6 ones that are amazingly well, like that do amazingly well. But they can't. You can't pick and choose the cities that are going to do well. You can't pick and choose the stocks that are going to do well. So our approach and our thought process, and I think Rob in here would agree for sure because he did this research, is that you have to look at the correlation of different securities. So here's some of the correlations. And by the way, you can run this a bunch of different ways, and correlations are very fluid. They shift and they ebb with time. But the thing that you have to keep thinking about, or what I think about with correlations, is I think that you have to realize that trading uncorrelated tickers allows you to be, I think this is your words, Rob, so tell me if I'm right on this, because I think you said this too. It allows you to be vaguely wrong rather than precisely, potentially catastrophically wrong. So when you trade a basket of securities, you can be vaguely wrong on some of these, and they will be more or less overshadowed, or should be, by the other ones that you're right on. But if you trade 1 or 2 things and you're precisely wrong, you blow yourself up. Is that a good idea? Like, does that concept make sense? Like, you'd rather be vaguely wrong than precisely wrong. I think Rob told me at one point, because I think I wrote this down, will never forget it. The latter is catastrophic. The latter is catastrophic. So what you can do, and we did the heavy lifting for you, you can start to scrape all this, or you can send us an email. We've sent this out to a bunch of people 1 million times. We talk about it all the time. We went through and we started looking at correlations. Correlations in 1999 of different tickers that we had access to. Correlations in 2000, we got more data. Some tickers don't go back that far. Correlations in 2001 and 2002 and 2003, etc. What you find is that when correlations, and I'll say this, what you find is that when correlations become very loose, watch out. I'd say that's the one big thing that I took away, is that right after 2001, right, in 2001, 2002, do you notice how tight these correlations are? Pretty much every product traded about the same as the rest. as the markets were finishing crashing up or crashing, right? Products traded about the same as the rest. So energy and XLF, right, which is financials, and XLP and utilities and healthcare and all these other ones, they all traded the same. Do you see how tight these correlations are? The graphic here is very, very tight. Let me try to zoom in on this a little bit more. And then what happened is that as we got later into the middle of the bull run heading into the '08 crash, notice visually, just with your eyes, how the correlations started to loosen. Do you see how they just loosen up? There's not these heavy greens. And then right before the crash, do you see how loose these correlations are? There's things that just are totally look like they're lopsided. And the reason that this happens is because you have runaway stocks, right? You have runaway securities. Things that used to be pretty correlated together now start to have these runaway securities, like a Tesla or a Snowflake or a whatever. And when you have these runaway securities, what you end up having is you have what looks like a lot of like loosely or negatively correlated stuff. So what do you think happened the next year in 2008 and 2009? Watch this. Oh my God. Someone was offended when I said that, but it is what it is, right? Oh my gosh. Or as my kids would say, oh my cheesecakes. Basically, what happened was everything auto-correlated together to effectively one. Everything moved as one big group. Do you see that difference? The difference between 2007, when everything looked really, really, really kind of loosey-goosey, and then 2008 was like, what? This was just 2008. Everything moves together at that point. Everything moves together at that point. And you go forward in time, and this is why we've said this for the last whatever years, right? Now you start going forward to 2009, things are getting a little bit more loose. 2010, they start getting loose. 11, 12, 13, right? Things are super loose. 2019, last year, correlations, super loose. Things are not, they start to diverge. Things that typically would trade together and trend together start to diverge because you have runaways. Stocks run away from bonds. Bonds run away from gold. Gold runs away from this. Utilities run away from whatever. And they start to really diverge and widen out. And when those correlations become very, very loose, well, we know what happened in 2020. It just happened to be that a catalyst might have picked the pin, but we could have been in the same situation just as easily. Is that pretty cool to see that? So if you graphically represent this now, and I'm going to get, the reason I think this is so important is because one, you can't trade just one thing. So we have to trade a basket of things, but we should also understand how that whole basket can be knocked off the shelf. I'll say this again. We can't trade just one product. We can't trade just SPY. If you only trade SPY, there's many times where you've been wiped out. You wouldn't be here if you really traded it full, like all the way. So we know we can't trade just one product. Let me go back to my screen just for a second because I want you guys to understand how passionate I am about this. We know we can't trade one product. We know we have to trade multiple products. SPY, TLT, GLD, whatever basket of securities is your basket. But what people fail to look at is how that whole basket can be knocked off the shelf. Like, what are the market situations where this basket seems like it works pretty well until something comes along and just poof, like knocks it right off the shelf? A black swan event. So just as much as we should understand why we want to trade something that's uncorrelated, because we get all the benefits of this going up and that going down, we also want to understand when that breaks down. When does that whole system break down? How often does it break down? When it breaks down, what do we need to do instead? Does that help out? Let me show you guys this in the file. I think this will be pretty cool too. So when we started looking at the rolling correlations, and the correlations of tickers to their baskets, meaning this chart right here, this I think is one of the coolest charts. This autocorrelation chart, it basically tracks all the individual correlations to the correlation of the whole basket of securities. But what is so fascinating about this chart, and the only one that kind of looks odd is bonds because it goes usually in inverse. But what's so fascinating to me is that when you get to these market crash type environments, 2001, 2002, do you notice how the whole basket starts to gravitate towards one? And then until we get to 2008, things loosen up. Do you see how the correlations, like there's spaghetti, like they just loosen? They start to trade more independently versus more dependently on each other. And then guess what happens? 2007, 2008 comes along, boom, everything zoop, autocorrelates to near one. Everything starts grouping together and moving together. And then pretty much until 2020, we had very much the same type of thing, very loose correlations. It was only just a matter of time before we had a black swan event. And everything moved together. And we didn't do the data here because we did this before that, but if you think about what happened in March, everything crashed, including gold. And everyone thought that gold was the safe haven, and it was after the crash, but during the crash, everything came down together. Now, Rob had a good point here, and I think this was really important. This is a good point, Rob. Someone asked the question, where did this come from? Let me throw this up on the screen. Where did this chart come from? Is our own research. This is our own research that we did. These are our own files. But Rob had a really, really good point here. I want to highlight this. You know, thank Rob. Thanks for being here. He said the idea here is that it will make no difference to change tickers if you replace one ticker for one that's highly correlated to it. If you take Facebook and now trade Twitter, it probably won't make a big difference. If you take Tesla and now trade GE, yeah, those are different tickers. So what we want to be able to do is figure out how do we trade the tickers in a basket that are as uncorrelated to one another as humanly possible. That are as uncorrelated to one another as humanly possible. And we do a lot of this already for you. We did this, and I think we can share some of this, but we do a lot of this already for you in some of these rolling correlations and some of these baskets of correlations. So if we go to, let's go to SPY, for example, to the actual ticker itself. Oh no, we got to go to the year. So let's go to like 2019. You can go down to sets of correlations. The 15 tickers that were the most uncorrelated to one another were these ones right here. if you just wanted to trade 10 different tickers, you'd probably want to start with these 10 and then intelligently interchange them. But what you find is you generally find the same theme over and over and over again. This to me was like the high level, I don't know, like this to me stood out more than anything. If you think about the ones that are in these lists of 10, 12, 13, 15 uncorrelated tickers, it's all the major food groups: emerging markets, euro, high yield bonds, silver, gold, oil, biotech, materials, energy, financials, healthcare, tech, retail. Right? The idea that I saw coming out of this correlation stuff was that as long as you intelligently have allocations to different sectors and industries, you get yourself most of the way there. And this really shouldn't come as a shock to most people. Like, there's a lot of research out there already on why a globally diversified portfolio, or even a diversified portfolio within the US, does better than a highly concentrated portfolio. Does that help out? So now when we talk about trades and duration and whatever, now we've got to add this additional potentially layer of complexity that we've got to do all those same things. Trade different durations, different strategies, right? Trade small position sizes, but we have to now do them across many, many, many different uncorrelated tickers. Many different uncorrelated tickers. So that we reduce the volatility of the whole portfolio as a whole. So that we don't have a portfolio that's going up, down, left, right, sideways, that we have a portfolio that's generally pretty stable. Does that help out? Yeah, so a lot of people are asking questions like, are we going to build this into the bots? I think we will have some component of this at some point. We're doing other things first. Like, it's just another layer of complexity that we haven't gotten to yet. Probably one that you could manage yourself a little bit, and you could just turn off and turn on bots, or have triggers to turn them off and turn them on. But it's something that I want to do. I know Rob does too. And if you want to do stocks, so like this is a good question too. Let me throw this one up there. Should we mostly trade non-correlated ETFs and not stocks? I mean, look, I think you can trade stocks. I just don't think you should only trade stocks. I think in many cases, if you have also a basket of uncorrelated ETFs, or a basket of mostly ETFs and a few stocks, then that's what I think, could help add some diversity and reduce the volatility of your account. So do I think that you can't trade stocks? Like, I don't like to trade a lot of stocks, but I'll short Tesla here and there, right? I'll short Tesla here and there. I got no problem with that. Somebody asked, this is a good question, John. Let me get this. This right here, does anybody know what this is? Somebody said, what is the note in the glass frame? Anybody know what this is? You take a guess first. It's just fun. Just take a break and then we'll get into some other stuff. Anybody know what it is? Oh, sorry. I said XLY is consumer discretionary. Yeah, it's not tech. My bad. Yeah. But still. Okay, you ready? Anybody know what it is? First stock certificate. That's the one up there. This one's different. Grocery list. This thing reminds me of where we're going. I'm not going to lie to you guys. I think that when I look at this, this reminds me of how far this industry should go. Okay, you ready? This is an original stock certificate or an option contract This one's from the San Francisco board of trade. That was the call side. This was the buy side. Depending on what side you were on, you tore off that side. And then you had your strikes and your expirations and everything in there, and you just wrote it down. And I keep this here because I want to remember this is how far we've come in this entire industry. That this was the starting point where you physically tore a position off and you gave it to the other person. Isn't that awesome? I love it. Because now we have bots, which is cool. Someone said, it hurts my soul how bad it was. All right. I want to do something. Now I want to change gears here just a little bit. And I want to talk about broken models. And I can't really even talk about this until someone said older still, it was still handwritten. Let me do this. I want to read to you guys a couple little paragraphs. Can I do this? This is the book, show 173, I believe. We interviewed Richard Hudson. Mendelbrot died, unfortunately. But we interviewed the co-author of this book. I think it's show 173. And I want to talk about broken models because I think it's so fascinating. And there's a quote in here I want to read from this page, by the way. See, I just highlight all of this stuff all the time. Sometimes I highlight the whole page. But the next thing that we have to talk about, which kind of goes into this area that we were just discussing with correlations, we're like, when does the whole basket fall off the shelf type thought process? Like, when does the whole thing, why my screen looks a little bit janky. There we go. When does the whole basket fall off the shelf? And I think if you've listened to show 173, hopefully somebody can post a link in there to that podcast. You'll understand that basically the models that we use for options are flawed. And they're flawed because they assume a normal distribution. They assume that markets don't have a memory. They assume that days are independent of the next day, which they're not. They're mostly correlated or linked together. And if you just have a concept, if you have conceptual awareness of this, because there's no solution to it necessarily, I think it allows you to sidestep the biggest blows that the market could have. Does that make sense? Like, you're going to get a punch. Here's the book. You're going to get punched by the market time and time again. You just can't get the knockout punch. Right? And I think that March of this year was probably a knockout punch for a lot of people. I hope it wasn't, but I think it was. Okay? Here's a quote from the book. Seemingly improbable events happen all the time in financial markets. A year earlier, the Dow had fallen 7.7% in one day. This was 2007, I believe. The probability of that event happening was 1 in 50 billion. Does anybody remember when that happened? We eclipsed that, I believe, during the crash. In July 2002, the index recorded 3 steep falls within 7 days, with a probability of 1 in 4 trillion. And on October 19th, 1987, the worst trading day, at least of the century, the index fell 29.2%. The probability of that happening, Black Monday, the probability of that happening was less than 1 to 10 to the 50th power. Odds so small that they have no meaning and are outside the scale of nature. I don't know what you guys think about like that, But what that is telling us is that the models that we currently use for options trading, the Black-Scholes and all this stuff like that, they do not accurately represent nor do they predict the magnitude and the frequency of large 2, 3, 4, 5, 10 standard deviation moves in both directions. Okay? And there's two, I think, really, really important concepts that I want to draw out. Two really important concepts that I want to draw out, hopefully, here doing this. All right, I'll take myself off. I'll make this one bigger. Can you guys see this screen? God, I really hope these come across really well. Really hope these come across really well. Can you guys see this okay? This is a normal distribution. Unfortunately, this is what most, or a version of this, there's some slight versions of this. I'm simplifying it just a little bit, okay? There's some scaling and there's some skew and stuff like that. But most models are basically based on this distribution graph. And the idea is that basically about 68% of the time stocks trade within a 1 standard deviation move. You guys have all heard this? May not be new. And then you've got your 2 and your 3 standard deviation moves out here. So these are your 1 standard deviation moves. These are your 2s, and these are your 3s. The 3s should be, if the model is accurate, the 3 standard deviation moves out here should be small in frequency and small in magnitude, meaning that they shouldn't happen that often. And when they do happen, they might be big, but they're not like crazy big. That's the assumption. On both ends, by the way, it works on both sides. Okay? The problem is that these events out here, they happen, if we were counting the times that they happen way more than the market's models anticipate. And the magnitude of moves, the further you get out, becomes greater and greater. So they don't just tail off like this. Their magnitude is ginormous. And their frequency of occurring is much more frequent than markets expect. Does that concept really resonate if you haven't heard this before? Because I just read it to you essentially that things that should have never happened on any natural scale happen all the time. You only have to look back to earlier this year in 2020 in March when markets absolutely imploded. The other thing that we find though, and this is I don't know how to describe this. So I'm just going to say as best I can if that helps, if that works for you guys. The other thing that we find in a lot of research, not only here, but you can check other people, they have other research as well too on this. The other thing that we find is that when you look at the distribution of returns, and we know that we have these fat tails, we also find that we have insanely skinny centers to this distribution. Meaning that when we say implied volatility over assumes that markets are going to be less volatile than market participant expected, that's true. That's true only within the context of this particular range right here, where you actually have more cases where the market stays neutral, range bound, symmetric, whatever you want to call it. You have a lot of cases where, regardless of volatility, markets expect lots of volatility and then they don't get it. The problem, as I've always seen it and still continue to see it here, is that most of the time you do have markets that are like this. That's what most of our trading is going to be. We're going to be trading when markets expect a 10% move and we only get an 8% move. And that edge, that 2% difference, that's the money that we make as traders some way, somehow. Trading that edge in volatility. That's one of the ways that we make money. And most of our time is spent in the realm where the market expects one thing and is underwhelmed. And then there's a whole other paradigm that occurs on these tails. And when you get to these tails, this thing in the middle doesn't matter at all. So the personal struggle that I've had, I'm just telling you my personal struggle with this. How can you build portfolios that accomplish both? That accomplish both. And I don't know that there's a perfect answer to this. I'm definitely not saying that there is. But I think there has to be a way, and I think bots eventually become the solution to this. There's got to be a way to turn this off, turn this type of strategy off, and turn these types of strategies on that profit from these. Long tail, long volatility exposure, there's got to be a way to figure out or to start doing that process automatically where you turn or shift allocation into those tail exposures. Is any of that concept making sense? I know I just drew like all over the screen. I'm looking at my own screen. I'm like, man, if you guys followed along on this, more power to you. Because I move fast and I talk. If you think this is how my mind is what my wife tells me what my mind looks like. But I think there's two paradigms. I think there's two paradigms of trading. I think the two paradigms of trading are there's just regular markets, right? The first one is just regular markets, whatever that looks like, because there's no regular market. But just non-black swan markets. And then there's black swans. In both directions, by the way. In both directions. And I think as a trader, you have to be focused on this, of course. Like that has to make money. That has to be positive expected outcome. All that stuff that we're going to go through here today. But I think there's got to be a portion of your account focused on this. And this is, guys, where I think, guys, girls, gals, whoever, this is where I think bots are insanely useful. Because they can at least give you the possibility to start turning that on at certain thresholds. Or at least start scaling into it. Like you could say, and we'll build some of these out tomorrow, but like if the VIX is above 30, then get into one contract. And then if the VIX goes up and is above 40, then grab 3 contracts. Right? Like you can start building these systems with bots that start increasing their allocation at different levels and thresholds. If the market's down 5%, grab 1 put contract. If the market's down 10%, grab 2 put contracts. Whatever that is for you. But I think what you have to understand, and hopefully I described it as best I can here, what you have to understand is that markets are way more volatile than we think they are. If I was to draw this out, another great concept around this is, we had 2 peaks and then we had this, okay? So this was 2007, this was 2000, and this was 2020, roughly. When we track the number of days, oh, you know what? I actually have it. Hold on a second. No. Drawing it doesn't give it justice. Can I get the days for you guys? Check this out. Watch this. This will be so cool. Rob, you can chime in anytime on these too. You can chime in anytime on these too. Let me grab these. Okay, these are so cool. These are so, so, so cool. Let me switch over so you guys can see this. Okay, this is really cool. By the way, our team put this together. This also comes mostly from the inspiration of this book, though we did some modifications to the data. But we definitely do not claim to have this from this. And the other good book on this too, by the way, is a book called Muscular Portfolios that kind of describes the same theories, but it comes from Mendelbrot plus Muscular Portfolios. But we just put these into charts that will be used in the new handbook that we're going to be releasing. Okay. Can you guys see this, the volatility clustering? What is so fascinating, I think, about markets and volatility is that, remember I said, like, there's just really two paradigms I think of. Like, there's regular-ish portfolios, and then there's these really volatile periods. When you actually track the volatility and the daily change of different markets, you can physically see. Oh, no, you can't see this yet? Oh, wait, sorry. There you go. Now you can see it. You can physically see the change and the clustering of high volatility periods together. Now, the reason that this is so important is because this should never occur. This should never occur. If market models and pricing models of options and all this stuff was accurate, this should never occur. The volatility should be normally distributed, evenly distributed. So this is one way we can track it. The other way, here's another way we do it too. Another graph. Here's the overlay of the S&P with the daily change. Notice when markets are crashing, how volatility and the frequency of high volatility days expands exponentially. Do you see that visually here? These spikes of big up days and big down days? These spikes should never occur if markets were truly independent, had no memory, had no concept of what happened the day before, but we do. Markets do have a concept of what happened, and markets do have a memory. Here's another one, probably my most favorite one. Here's just the high volatility days over 3%. These are just the days with price movements over 3%. Notice for long stretches, years sometimes. For years sometimes, you have markets that will trend and never have a daily move over 3%. Like after 2011, you basically had 3 years of no market movements ever over 3%. And then you have these periods where you have market movements over 3% in both directions, highly clustered on top of one another. The reason I show this, Alex said, I don't understand the chart. The chart shows the S&P's price, and then the dots are any days, just tracking the days where the daily move was over 3%. Either up or down. Down moves are dots that are red, up moves are dots that are green. Somebody said, how is that possible? It's just possible because when markets get into a cycle of moving down, they tend to continue to move down until they don't. When they get into cycles of moving up, they continue to move up until they don't. They have a memory. I think that's what I've learned in this whole thing is that markets do have a memory. Yesterday is not completely detached and independent from today. And I think that these movements continue to probably be more exaggerated right? The reason why this is so important, I'm going to leave this here and I'm going to talk directly to you because I think that this is so important to kind of leave here and just like, I just want to talk about both of these. Okay. How do I do this? There we go. There we go. Good. The reason why I think this is so important is because to bring it back around to before we get into back testing, if you are not looking at as much data as you can and looking at the biggest timeline as you possibly can get, you could easily find yourself analyzing a microscopically small market scenario or situation that might have just randomly worked out favorably for a strategy. Like, I truly hate when somebody sends me something and they're like, this strategy worked for 2 years, and then they're going to trade it. And they think they want me to defend why I trade something different when they found something for 2 years that worked amazingly well. And then I look at this chart and I go, anything could have worked amazingly bad or amazingly well in a very short period of time. So I think hopefully what this chart does for you is it forces you to think longer term about how strategies might go through various regimes of trading. Volatility regimes, high volatility compressed in a short period of time. Does it survive through that or does it not as you start to go and start to dig through strategies and testing? And how can you develop different strategies that might reduce the sting of those types of environments? Right? Because you can't avoid every market punch, but hopefully you can sidestep the big ones. Hopefully you can sidestep the big ones. All right. Is this good stuff? Feeling good? My son, every time I say that, he goes, like I should. Thomas said, what I'm hearing is that sticking with the same strategy that worked from 2002 to 2007 will wipe you out. Well, it may have. It's just that if you look at a strategy only for 5 years, recognize the type of environment that you're in at that time. Just recognize the type of environment that you're in at that time. Does that help out? And continue to evolve your trading. All right, I'm going to show you guys something different too. This is Otis. I'm going to draw this out. I'm going to show it to you first. And then I'm going to draw this out on the screen. Is that fair? But this way you guys have context. So if you're not watching right now, you need to bring your eyes back here for 2 minutes. Because I got to show you this. This is Otis. Let me back it up just a little bit so you can see it. Otis is a framework for how I mentally think about trading. And I hope it's a framework you can adopt as well. As you notice, Otis has some rotations and some circles. And it is put together in the shape of an infinity loop with 2 very specific sides. The strategic side and the tactical implementation side. I want to go through this together because this hits on a lot of the topics that we just talked about, and I hope that it is a mindset that you adopt as well. And I promise you this is going to be the framework for how we start doing things moving forward. Does that work? Everyone get your screenshots? Everyone's like, get my screenshot. Okay. All right, good. So here's what I want to do now. I'm going to take Otis. By the way, I don't know if you noticed, but it's like taped together. Do you guys see that? Like I had some things and I had to retape them together and put them together. Okay, so it's been hacked up. It's continued to be an evolving thing. But here's the thing, right? I think that if you understand this concept around the two circles that kind of feed one another, like it gives me chills on my hand right now to think about it, because I think it's such a cool model that you can use any place. Like I think it doesn't have to be options. It can be real estate. It can be stocks. It can be whatever. I think it's such a cool model that you can use any place, essentially. I think you can use it any place. So let me do this. Let me just want to do a little markup again. Okay, you guys should be able to see this screen with the markup. So here's how Otis works. Oh boy. Hello, Otis. There we go. I don't know why it doesn't work there. Start. There we go. You guys see this? So Otis works in this framework. The first thing that you have to do is you have to assess your risk, what we are going to call your risk profile. This is the first block. I'm not going to draw it as beautiful as what I did on the other one, but this is how it works. Actually, do you guys have a copy of this that I've sent you before? Have I sent you a screenshot of this? I might try to pull it up as a screenshot. Actually, let me do that. Let me send it to myself. I'm going to pull it up as a screenshot. I think it'll work out a little bit better. That way I don't have to redraw it out. Isn't it fun when you can just screenshot yourself? Okay. Let me try to do this. Try to send it to myself. Thanks for your patience, by the way. Appreciate it. I think you guys will enjoy this. More drinking coffee, yep. It's just much better than me trying to redraw it out here. I should have done this earlier, but didn't think about it at the time. Do. Man, I swear it takes forever to get something to yourself. All right, let me get in here and try to get this. Steve said, how much longer is this call? I may have to leave. We're going to go till like 5 o'clock-ish. Does that sound good? Yeah, do you guys like that GIF in there? I talk in GIFs, by the way. Anybody who knows in here? Rocco, by the way, said, hey, I'll jump in and answer questions. I was like, yeah, sure, of course, you can answer questions. Totally not thrown in there. Man, I can't get this to send to myself. Yeah, 5 Eastern. Yep. Sorry, just bear with me. I'm trying to get this in here. And then we can talk about it. Because I think it's so much more valuable if we can do it here. Do you guys agree? Yeah, I text myself all the time. Really quick, can you guys let me know in the comments what's the biggest takeaway you had so far? Any big aha moments? Any big aha moments? Yeah, I do have 2 screens here, but I can't share the screenshot thing when I draw on the computer unless I throw it up here. It's really, really weird that I can't do that. Yep, we're doing a recording. Correlations in the fat tail. Importance of position size. That I teach the same things over and over and over again. Otis, like the Otis sprocket, like the idea of breaking down trading across the spectrum. Very good. Apparently, I cannot get any freaking thing to work. Just to take a picture of it. Okay. Diversification of the portfolio. Breaking down the trading across the spectrum. All right, I'm going to do it this way. I think you guys are going to like it still. I'm just going to share Otis on the screen and talk through him. Cool? Somebody's feeling a little bit overwhelmed. I get it. I understand. It can be overwhelming. All right, cool. I'm going to share Otis on the screen. I'll try to keep him here, and we'll talk about bits and pieces of this functional process. The first part of this process is right here. Risk profile. The risk profile is basically you figuring out what type of trades and strategies and systems and profits and drawdowns are appropriate for you. That's the first part of everything. Like right now in the chat, this is really fun. Right now in the chat, tell me What is your maximum threshold for risk? What's your maximum threshold for risk? If you have a strategy that loses X%, when do you tap out? When do you tap out? When do you say enough is enough? $2, $2, 90%, 5% of the portfolio, 25% of the portfolio, 100%. Per strategy, I can't ride through a 30% drawdown, 10%, 5%. Someone said I never tap out. Seems to be about 40%. Might be better. If I write up on the board, I'll try to. I'm still trying to send it to myself. 30%, 5%, 250 per trade. 3%, 5%. Do you guys notice how you're all different? I'll just make like one sidebar comment. When people ask, why would anybody trade the strategy completely differently if the strategy won? Like, you guys all have different thought processes. Do you see like you're all totally different in when you would stop and exit a position? You might sell early or late or whatever. Every one of you is completely different, as you should be. As you should be. The purpose with doing this and showing this is because I want you to think about, and your starting point for anything that you do on Otis, the starting point right here is your risk profile. When do you say, cry uncle? How much money do you want to make? What's a good profit metric for you? What's a good win rate? What's a good win rate for you? This is fun. This is fun to go through with hundreds of people on here. What is a good win rate for you? Is it 10%? 20%? 50%? Does it matter as long as it has a positive expected outcome? Right? 70%, 100%, no lie. That's okay. True man. 100% win rate. 25%. So this is funny, right? I know people for sure who they think that if they have a 10% win rate, because they bet so aggressively that wins for them. Like, that's for them. That's the high level watermark. If they get a 10% win rate, they're super, super happy. Right? You guys are all different. But these are some of the things that you should just etch out and sketch out and just say, okay, this is what I'm looking for. Now, by the way, I think this is a good comment that Bill had. When the expected outcome is positive. Because here's the beautiful thing. It's not that you have to get a 70% win rate or a 50% win rate or whatever. You should just be looking for things that have a positive expected outcome. But if you've got the choice of 5 or 6 different things to choose, then yeah, maybe you choose one that has a positive expected outcome with a high win rate. Right? Win rate is just one component. These are some of the things that you should start thinking about as you think about how you want to trade. Now, be open-minded as much as you can that there is not one answer to all of this. But you might set some boundaries for yourself to say, look, I'm unwilling to trade a strategy that makes money but loses 90%. Like, the strategy might win, but at some point it might have a 90% drawdown. Maybe I'm unwilling to go that far. Is that a fair assessment? So here's part 2 then. Part 2 is backtesting and research. And that's really just the start of the process. Once you have some general parameters, you need to start doing some testing and research. Could be a combination of them. We did some of that today. We'll continue to do some more of that here soon. you have to do some backtesting and research. And what you're after is you're after this, which is your quantifiable edge. You are trying to find strategies that have a quantifiable edge. That doesn't mean that they will always continue at the same pace moving forward. But what it does mean is that at least you're shooting in the right direction. Like I've always told people, if you want to drive from Florida to New York, driving north will get you going in the right direction. Driving south clearly gets you going in the wrong direction. Your trajectory that you take as you drive north may lead you through North Carolina, may lead you through DC, may not lead you through DC. You may go around New Jersey. You might go right through New Jersey. But you just got to be pointing the car in the right direction. And that's what I think backtesting and research does. Guys, backtesting and research is not the answer to everything, but it steers the ship to say like, yeah, I need to start doing things like this. Then how can I improve it? No, I need to avoid doing this because I can clearly see no matter how I do it, it's going to lose. I'll show you guys an example of this in the when we go through here and we do some of the research stuff. But like there's some things that just never work. Like no matter how awesome you put it together, they just don't ever work. Does that make sense? So you got the first two things of Otis. The third thing you need to do here is you got to find liquid markets. Is that clear? Hopefully it's clear. You got to find liquid markets. If there's no liquidity, you can't trade it. If there's no liquidity, you cannot trade it. Do you guys agree? If there's no market for something that has a quantifiable edge, how can you be rest assured you can go after that edge over and over and over again? You can't. Right? You can't go after that edge over and over and over again. If there's no fish, why fish? Like, why would you go after it? Here's this screenshot. I got it. It's in here. So you have to go after liquid markets. Markets that are deep. Liquidity gets you tighter spreads. Liquidity gets you more access. You got to go after liquid markets. As you go further down there, the next thing here is diverse tickers. Now notice a lot of these I put some arrows that say like, hey, look, these are pretty interchangeable. Can you guys see here when I just do this? Right, like these are interchangeable right here. They're interchangeable. You got to do all of these in one component. But you got to do liquid markets. You got to have diverse tickers. And you've got to choose your trade duration. This one down here says trade duration. Does that make sense so far? Once you find a quantifiable edge, it probably is going to lead you into choosing the markets, choosing the tickers, and the trade duration. Does that make sense so far? Once you do that, you have to focus on trade frequency. How often do you need to do this? Is this something that you do once a week, once a month? How frequently do you need to do this? By the way, this is not just options trading. I think this model applies to everything you do trading. If it's a trend trading system, how frequently do you adjust the trend? How frequently do you add positions or remove positions from the trend trading model? And then the final step that you have to do on the strategic side is allocation. You got to figure out what the capital allocation is. This is this step right here. Capital allocation. I know it's drawn upside down. You can tilt your head sideways or whatever. Okay? But the capital allocation model is so, so important. And when I say diverse, I mean uncorrelated tickers. Yeah. All of these things that we talked about, now I can draw on the screen. All of these things that we talked about at a high level today. Every single one of them, right? Because they're all so, so important. And for some strategies and systems and things that you run, they might have different little variables. And that used to be an issue. That used to be an issue because you had to remember, okay, wait, this one strategy I run has a 10% allocation and and I got to trade it every week. And then I got to trade it right? That used to be an issue. This is what I talked about earlier. You can scale your strategies because you're not limited by your time anymore. You're not limited by your time anymore. Cool? Is that cool so far? Now this side here, let me draw this out so you guys can see this. This side here is what I call the strategic side. This side here is the strategic side of what you do. And this whole system over here runs on education, getting into the right mindset and psychology around trading, and having the right community to have your back. The right community to bounce ideas off of, share ideas, support each other, fostered through education, and continuously supported by improving the psychology and the way you think about trading and investing. This strategic side is so critically important, and it's where all of it starts. Do you see how this hemisphere of Otis on one side is strategic? And it's run by these components in here. The whole framework is built on top of education, community, and psychology. Now, someone has a question. I'm confused on how you backtest a strategy that hasn't been formulated. These are all kind of components together, but you start doing the researching, the discoverability of backtests, which we'll show you here in a second, to start seeing what pieces you can move in and out of, right? Like you start looking at research and you find one research report that says you should use trends, or one that says you should sell options all the time. Okay, can we test that? Can we, now that we can find those in one ticker, can we find them in more tickers? Now that we've found them in more tickers, what duration do we need? What frequency do we need? And what allocation do we need to now start trading this actively? Does that help out? Backtesting is just the starting process of trying to find strategies that work, that have a history. And we're going to go through this as we backtest on the platform, but it's trying to get some sense of what worked generally in the past, and am I pointing in the right direction? Is this good so far? Can I move on to the other half? Once you've done some backtesting, here's the thing with backtesting. You can now run backtests and discover backtests that tell you all of these components inside of Option Alpha. It tells you if something worked or didn't. It tells you what tickers it was run on. It tells you the duration and the frequency and the allocation. So once you start testing and discovering new ones, it will start to lead into all of these things as to, okay, now that I've found a strategy, let me just double check that I have all these components in place. Investment objectives, needs, time horizon. That's your risk profile. Those are setting up all your goals right up front. Those are setting up all your goals and saying, this is where I want to be and this is what I'm interested in doing. Now let's start doing the heavy lifting of finding those things that work and making sure before we start implementing anything that we know exactly how much we allocate and why, what the frequency is and why, what the duration is and why. Let me move on to this side. Let me move on to this side. Ooh, yes, now I can draw with red. That's what I was hoping for. Once you have a strategy in place that you want to trade, you go from strategically thinking about doing something to tactical implementation. Do you guys agree? This side is thought, planning, strategy. What do I do and when? Why do I do it? Do I have the chops? Do I feel like I'm educated enough to do it? And this side is now, I got to run the strategy. This side is, I need to actually implement what I'm doing. Do you guys agree? There's thinking about trading, and then there's trading. And until now, this side has been a completely manual process. Completely manual. But with our auto trading, you can automate this whole process now. But whether you automate it or not, if you want to trade it manually, you can still do the same things. And here's what you would do, right? Think about how you implement a strategy. You scan for opportunities. That's what you do. You look for opportunities. You start with a list of tickers, right? And that list of tickers might be that list of tickers, but you might filter for certain things to be true. So you filter and analyze the opportunities. You start with a big base of tickers, things that you know you could trade, and you start to filter down into things that you want to trade. Once you do that, then you can actually execute the order. By the way, is this anything out of the normal process of what you do? You just do this manually all the time now. You look, you filter, and you execute orders. Then you have to manage the position, which also, if you don't use auto trading, just creates a huge time suck. Maybe you have to start doing things like hedging and adjusting the positions and the portfolio. Can you build in ways to remove or add positions dynamically based on market trends and indicators? And the answer is yes, you can. And we're going to build out a lot of those tomorrow. That's what we're going to focus on a lot tomorrow and the next day. But this is what you do in your process. You enter a position, then you have to watch it, then you might have to make some adjustments potentially. Then you have to track your performance, which is a clunky manual process that we're trying to get improved for you. And then you have to reevaluate if you should be doing that or not anymore. Maybe the process that you thought was going to work out doesn't work out for you. Maybe it works out incredibly well for you. But the reevaluation period is, to me, where I think this thing goes two different directions. Notice you can restart the strategic side, or you can continue on this side and continue trading in this loop. If the trades are working out and you're going through this cycle on the right-hand side, you're trading, you're closing, you're trading, you're closing, and you like the performance, it's doing well, It's doing what you thought it would do. Keep doing it. Let this side run by itself. But if it's not doing something you wanted, or if it's not performing the way you wanted, you need to go back to the strategic side and see how you can improve it. Maybe you go back and you start testing different allocations. And then you choose some different allocations and come back over and start replaying some more tests. Does that make sense? That concept makes sense of how we think about that? The right side is fed by the strategic side. The strategic side starts the whole process, and then it feeds into the tactical implementation side, which could continue in its own loop forever. And you only need to get off of this side when you feel like when the system isn't working for you. Maybe you need to spin up a new trade to add to the portfolio. So you let some trades continue working on tactical implementation, and you're over here going through the process of seeing what you can feed to the system again. I mean, it truly is like a beautiful synchronous thing that occurs. As you get new data and new metrics, that feeds into your evaluation of your risk profile. You might have started and saying, you know what, I'm okay taking trades at 50% possible loss. Now your new data comes in and you're like, well, maybe I'm okay taking 60%, or maybe I want to take 40%. But both of these sides feed off of one another. It's just that this side until now used to be all manually done. Your time and energy focused 80% plus on doing this side of the business, and you didn't focus enough time on this side of the business. Because this now requires zero time, because this side requires effectively zero time, now you can focus your 80% on this side and whatever percentage you want on the other side. All right, I know I hit you guys with a lot of information here. For those of you who are watching here, does this help out? This tactical side, by the way, is run. It feeds off of the core of the tactical side is data, technology, and in the near future, AI. How can you let things like smart pricing help you make better executions automatically? How can you leverage better technology like bots and automations that are fed data immediately, allow you to make better decisions? Is that pretty cool? By the way, a lot of people asked about the allocation piece. The allocation is done right before you trade. All that's premeditated. You should determine your allocation and your strategy, your frequency. All the things that you need to execute are all done on this left-hand side, the strategic side of Otis. The implementation side should be done automatically. All the things you need to implement are things that can be automated so that you can focus on this side here, improving the system. And if you find something better, you find a strategy that's better than what you thought it was, great. Feed it into the automation. And if you have a strategy that's running now, stop it and feed it with another one. Your goal as a manager of your account. I've talked about this before, but it's an interesting concept to think about. Your goal as a manager of your account should be how you can effectively convert risk to profit in an ongoing cycle. And that takes like stair-step progression of here's a concept. I wanted to go through this concept. I think this concept will help out, will make sense. I think this concept will make sense. And then we can dive into, and after this, then let's dive into the back tester. Does that sound fun? I think this concept will make a lot of sense to people, and I'm very much an analogy type of person. Okay. Very much an analogy type of person. I think you guys will appreciate this. By the way, Otis stands for Options Trading Intelligence System. That's our AI, and it's basically the framework that I use. Yeah, when it comes to all the AI stuff, by the way, Rob had a good comment. It's just machine learning, and we'll be totally transparent about how we build out stuff like this. When I say AI, I just mean like better data, just using data to optimize how we get into and out of positions. Let me give you one example. Rob, I don't even know if we've talked about this because I talked about it with Jack. And if there was a way at some point in the future where you could see the probability of your reaching max profit, and that could then determine when you got out of a position, so like if Otis or AI technology just running a bunch of stats and performing advanced statistics on positions allowed us to see, hey, there's a 90% chance you're at max allocation or max profit potential right now. 90% chance you're at a max profit potential right now. It could be 20 days, could be 10 days, could be 50 days, but based on the whole distribution of how this stock usually moves, right now there's a 90% chance you're at a max profit. That to me is interesting data. Me personally, I'm going to call that smart exits. So we have smart pricing, and then we have smart exits. How can we use technology to run the analysis as it's happening to give you data that's tradable? You guys think auto trading is it? Like, this is the beginning of what we're doing. But really quick, before we transition to this one point here, did you guys like the Otis stuff? Was that helpful? That's a hard concept to grasp. I'm not going to lie to you. Like, that whole model and how you think about it, like, it is not an easy model to grasp. But if you understand the two sides of it, the two circles, and how they feed off of one another, I think it brings a lot of what we said today together. I hope it does. I pray it does for you. Let me talk about this one thing. Actually, let's do this. Let me switch gears here for a second. Loved it. All right, good. Oh, this will be fun. You guys, you guys love the Otis. Nice. Really solid. Must have taken a lot of iterations. I feel like it did. I feel like Otis did took. It's probably not totally complete, but I feel like it did. Yep. All right, look, so when you have cars that drive, I have to describe this the best way I can. Let me do this. Let me try to do this as best I can. Oh, well, let me get the bigger image. One second here. Then we'll pull this thing up so you guys can see it. All right, cool. You guys are going to enjoy this. I think you will enjoy this conversation about this. All right, do you guys see this screenshot? Here's what happens. When you have cars that race, oh no, wait, hold on, sorry, I gotta always take over this screen. There you go. When you have cars that race, like Formula One cars, there's a lot of force on these cars, right? A lot of force on these cars. And you should be able to see the screen there. Yeah, you should be able to see it. All right, cool. So this is a Formula One car. Super powerful. Has to fly through the air and stay on the ground. Cars having hundreds of horsepower, thousands of horsepower, they actually have to physically stay on the ground, because what they are is they're prone, if there's not enough downforce on the car to keep it on the stinking track, they will fly up in the air. Right? So you see back here, I don't know if you can see my cursor, but on the back of every Formula One car, every race car, there's a rear spoiler. And that spoiler is literally meant, that spoiler that pushes air down and traps air as the car goes down the road, it creates negative lift and downforce on the car. Now you're thinking to yourself, and I want you to think conceptually about this for a second. Take yourself away from portfolios and trading or whatever. Think about just racing. You want your car to go as fast as possible. Why on earth would you put something on the back of the car that causes negative lift, that forces the car down on the ground and pushes it harder and harder and harder into the ground? Why would you want that? Intuitively, a lot of people would think to themselves, well, anything that makes the car go slower, like pushing the car onto the ground and not streamlining it, is a bad idea. Would you guys agree? Like intuitively. But what happens is that when you have this rear diffuser that pushes down on the car, the air pushes the back tires down, it creates negative lift and it increases the drag of the car, meaning the car actually moves slower. But what this allows you to do is it allows you to actually stay on the road. A lot of people have said it. Good. We got some racers in here. Proves the friction. Allows you to track the full force without spinning out. So it can hug the road, so you can turn, so you can brake better. But guess what it does? It reduces the top speed of the car. So you have to have this sacrifice when you put a rear spoiler on a car like this, that you know you are going to reduce the top end speed of the car. That's the expense side of it. The benefit side is you don't fly into outer space. You don't crash the car. You can actually brake and turn and maneuver. So the first component, I think, of building out a portfolio, and I'm going to try to turn this now to trading. I hope you get me as I turn this. No pun intended, turning like a car. When you're building out a portfolio, a collection of strategies that should work together, please recognize that you need to build a portfolio that sometimes has a rear spoiler, a component of your portfolio that in and of itself serves no purpose except when it's attached to the car. Except when that component that you've added to your portfolio allows the rest of the portfolio to have some traction and some maneuverability. Maybe a little less top-end performance for way better performance around the curves and the track. In trading, maybe a little less, this has got to be the best strategy ever and the highest performing, biggest return strategy, and more, hey, this strategy has to perform well and it also has to not go through a bunch of ups and downs. It's got to handle the corners and the market changes a little bit better. So when you're thinking about putting together your portfolio, you should think in these yin and yang components all the time. In racing, it's the power to weight trade-off, right? You add an engine that is a monster heavy engine, and you got to make sure that the weight of that engine is more than compensated by the extra power that the vehicle gets. Otherwise, just adding weight to a car that doesn't improve the power does nothing. Does that concept make sense? Now here's the one that's the hardest of all of them. To really drive home this concept, no pun intended, I said drive home. I didn't even know I said that. What value does the steering wheel serve? What value does the steering wheel serve? It's not a performance improving. It doesn't improve the performance of the car. Adding the steering wheel to the car and the car's like sitting there does nothing. It definitely doesn't really weigh much necessarily. But what it does is it gives you control. It allows you to maneuver this incredible machine or this portfolio all the time. And what you notice about cars is that cars don't have one thing that allows you to control them. They have a steering wheel, they have a gas, they have a brake, they have blinkers, they have mirrors. They have all of these things that help you navigate how the car maneuvers. And so what we've tried to do at Option Alpha is to give you all the tools to do this backtesting and the running of your strategies. But most importantly, I want you guys to understand, we gave you the steering wheel. There was one thing that we gave you that I think is the most important thing, is we gave you the steering wheel. We gave you the ability to put these together however you want, to turn them off and on whenever you want, to hit the gas or hit the brake or interfere or run interference whenever you want. And so as you build out your portfolio and you think about the trade-off between risk and performance and return, understand we gave you the steering wheel because it's the most important thing. Is that good? Do you guys like that analogy? All right. Let's get in and let's look at some back tests. Cool? Trade gears here. I just can't stop with the analogies now. I'm like, let's change gears. Ha, ha, ha. All right, cool. Can you guys see the back tester in here? You should be able to see it now. I hope that analogy sticks in your mind. Yeah, someone said, I hope this analogy will stick in my mind. I hope it does. I hope it sticks in your mind for a long time. Because it is such a trade-off that you have to make. You can't look at, if you get anything out of today, just don't look at anything in a silo. Like, look at it in the totality of it. So what I want to do for the next hour or so is I want to run through some back tests, and I just want to start to explore ideas. Is that fair? I want to explore ideas. I want to trade back and forth between the back tester and some of the research that we do. Just know that research is going to continue to be a big part of what we do at Option Alpha. We kind of had to pare a little bit of it back because we were getting out the auto trading platform, but we're going to continue to do more research. I want to show you some of that research today. And before we get into it, one thing that you should think about, and this goes back to the analogy of driving the Formula One car and why they use a rear spoiler, is that you should look for parameter stability. I think you want to avoid the idea that when you're doing testing, let me just go back to my screen here for a second, that when you're doing testing, everything is a binary decision, because it's not. I don't think that it's a binary decision. Did I lose everyone? I hope I didn't. Testing and portfolios and whatever, it doesn't have to be a binary decision. You can get bits and pieces and components of it. And what you're looking for, and what I think you're looking for, is you're looking for parameter stability. Like, what are the things that continue to remain stable? How do you keep the car on the road? Because a fast car that flies off the road serves you no purpose. Okay. By the way, this is the new back tester that will be available if you are an Elite Lifetime member. You'll have access to this new back tester. This is the one that we demo. Inside of the back tester, you have access to your back tests, all the tests that you run. Notice I ran a couple this morning about 8 hours ago. And any of the ones that you run, they just stay in your little piggy bank. One of the cool things that we've done in here, and we've talked about this on the demo, but it's worth repeating here, is that anytime you independently run a backtest, which it's not your portfolio, it's just a test that you ran, that data gets stored in our collective database, which then we can do some pretty cool things with it. Like, we can show you the top backtests that were run across the entire platform. And so anytime anybody, whether it was you or somebody else, ran a test that filters to the top backtests, you now have access to look up that strategy as well, because it's not private to them or private to you. You're just running a test on our platform. We also have this tab here, which is amazing. This is all Rob, so you guys can all thank Rob in the comments. That's called the Discover tab, that filters the best strategies for very specific key metrics, like fewest consecutive losses, most consecutive wins, right? So you can do that inside of the platform. And again, it's just to, again, give you some context as to how you can start to discover new ideas. So I want to show you how you run a backtest first, and then we can start digging into some backtests and how we can kind of manipulate the data and move around with the data. Again, this is not the end all be all to say this is how you do it. This is just truly to show you some of the flexibility and some of the processes you should go through to start discovering what those strategies are that you're going to trade. If you go back to Otis for a second, This is this side over here. This is the strategic side that you have to focus on. Unfortunately, for most people, this is a side that I think most people try to ignore. Try to ignore. They try to ignore this side and they go, oh, well, I'll focus on it later. It's much easier just to look around for a good trade. So when you get in there, you can run a new backtest. We'll type in a symbol. Let's do IWM. We do have some backtesting durational periods. If you're only concerned with something that happened over the last year, 2 years, 3 years, 5 years, whatever, you can do that. I would just always default to all time. Just pull back as much data as we possibly have access to. Remember, some tickers don't have data going back that far. But if it does, then you can pull all that data. The trade frequency, you can do sequential, which is one after another, adding new positions every week, as long as there's room, adding positions every month, or adding positions quarterly. So we kind of expanded these out here a little bit to add positions quarterly. We did a lot of testing around the daily entries because that's what we do now, but we found that for the most part, even if you set it at daily, you wouldn't necessarily make a new trade until about the next week based on parameters and sometimes allocation. So we can continue to expand this out, by the way. And by the way, the backtester is by no means done. We're always going to be adding and improving it based on your feedback. The next thing that you can set, and this is by far the coolest thing in here, and this is why I didn't start this masterclass today with doing this, by the way. If you went through this whole thing, and I hope you did, and if you're watching this later, rewind and watch it again. This is why I saved this component until after we explained all of the different pieces of trade duration and portfolio and risk and allocation and sequencing, because this makes a lot more sense when you know the context behind it. So with regard to capital, you can now choose starting capital positions. So if you want to start with, say, a $10,000 account, this will be cool. Let's start with a small account, $10,000. We can compare 3 different allocations. Notice they use a lot of the similar recipes that we're used to anyway. So we'll start with just a small allocation of, say, 5% per position. 5% per position. No max on how many positions or how much it can allocate. Again, this is not saying this is right or wrong or whatever. It's just a way to test. Another one might be 5% per position with a max allocation of 30% for all positions. So we're going to test this same strategy that we'll build out across 2 different types of models. In fact, we can add a third one where we can say, okay, if we have a $10,000 account, only do, let's say, $700 per position. So if the value of the account goes up, we're still trading $700. If the value of the account goes down, we're still trading $700. Do you notice how you can just be very flexible with this? We can continue to build out different recipe styles and versions, whatever, but I think it gives you a lot of flexibility just with the ones that we have. Would you guys agree? Is this helping out so far? I want to make sure we're good here before we keep going forward. All right, good. So that's the allocation. That's the capital. Does that make more sense now why we put that there after going through today? It should make it like so much more sense now why it's there. Cool. Now we're going to choose the strategy. Let's do a neutral iron condor. So we choose a neutral iron condor. Now all the parameters that we can choose in here come up. And again, we can continue to build out, improve, tweak these things based on feedback and what works best for all of us. So let's do a short 30 delta and a 20 delta wing. So short delta of 30, long delta of 20. There's a pretty narrow spread, but remember, we're trading in a small account, so we really can't go that wide or else it's not going to trade anything. We'll do days to expiration. Let's do something 60 days out. Remember, we're adding a new position every week. The closest to 60 days every week, we're adding a new position. So one week it might be 45 days. The next week it might be 52 days, might be the next closest, or the next one might be 68 days. But we're closest to 60 days. I do think we have a threshold in here, Rob, isn't it? Like around 5-10 days, something like that. There's a threshold that's if it's too far out of that range, then we throw it out. You can filter by IV rank, so we'll just say no filter in this case. If it was a stock that could have earnings, you could say, you know what, avoid earnings. This is a big requested one that people wanted too, which was don't trade through an earnings environment. Right? If I'm going to make a trade on a stock, don't trade through an earnings environment. Profit taking, we can take profits at 50%. We could set a stop loss, or we could say, you know what, close the position no matter what 10 days before expiration. So this is where you can start to do some more of these dynamic exiting. And then we click run backtest. So now that the backtest is running, it should pop up here and say that it's running. We can just go to our list here, and you can see that the test is running. It's not yet done. Depending on how complex your strategy is, it may take a couple minutes to run. That's okay. You can build up a big piggy bank and let them all run and then come back and check them. Is that pretty cool? So while that's running, because it might take a minute or two, let's look at this one that I built out already. This one is a long call strategy, and I ran it earlier today. Now let me go into the edit field so you can see what I did. I used all time. I entered this position monthly. The idea with me actually running this, to be totally honest, was can I add a simple monthly far out long call with a small percentage of my account, and will that do well in this raging bull market that we generally find ourselves in? Right? That was the genesis of my thought process running this particular strategy. Can I add just once a month a very small long call position and see what it would do? So I said, okay, I'll start with $20,000 of capital. You could change this up. And I was just going to test 1, 2, 3% allocation. That's it. So every month, allocate 1% of whatever the portfolio value was, or 2% or 3%. And then I did a long call at the 10 delta, so far out, 30 days or 40 days from expiration, no IV rank. I would take profits always at 50%. So if I had a profit early, I would take it. And this was the performance of that particular backtest. So that particular backtest showed this distribution of the 3 different types of portfolios. Notice that they are very similar to one another, but their performance, their total dollars that they made, is quite different. Do you guys agree? Quite different performance. The 3% of capital clearly was the underperformer. They all lost money, but the 3% of capital, really just kind of took it on the chin. The capital at risk down here shows me how much of my starting account balance I had risked at any one point. So this is kind of cool, because as you'll start to see as we do more of these tests and kind of go through some more of these, you'll start to see that at various times your capital allocation could stay high or trend lower. When you start to go down further, you can click on the tabs of the allocations that you tested and see all the performance metrics. Now look, this is where, and I totally get it. This is a lot of data, but do you remember when I said earlier today that it's so important that you have all the different metrics, because it's not just win rate. It's not just what the return was. It's looking at all of the combinations of things to see if this is a strategy that you might want to deploy or try a variation of. Right? So in this case, the 1% of capital had a total return on capital of negative 10%. Here's all those stats. Here are the performance ratios, which this one is a big one for me personally. A big one that I will look at a lot is profit factor. Profit factor essentially says, for every dollar I put in, did I get $1 or more out? So in this case, and it takes the total gross profits divided by the total gross losses. So it's one way just to like cancel out a lot of the noise from a strategy to see if I made more money than the system lost. Does that make sense? The profit factor here was 0.89, which means that effectively every time you put $1 in, you got 89 cents out. The max drawdown, also a big one that I'll look at. Max drawdown shows you what the most biggest drawdown the position took at any one time. Peak to trough. So this one lost 23% peak to trough. Win rate shows a lot, shows number of positions that it traded, which is important. If it makes 10 trades and crushes it, do I think there's a high likelihood that it's going to do the same in the next 10 trades? Probably not. Win rate was just about 50-50. The losing streak, winning streak wasn't pretty, crazy there. Duration, I held trades for about 24 days. So even though I traded them for 40 days, I only really held them for about 24 days. Maybe I got out mostly at profits early. And then you can actually see every single position that it entered. You can see how it scaled up or scaled down positions, the debit, the credit, how much it won, it lost, etc. You can visually see that. Is that pretty cool? And you can do that for the other ones. So if I go to the 3% allocation, now I can see that my profit factor was about the same, which shouldn't seem out of the ordinary. Win rate was about the same. Shouldn't seem out of the ordinary. I just lost more money. I just bled the account dry much faster. Right? I just bled the account dry much faster. By the way, inside of your bots, when you start running bots, your bots start tracking a lot of these metrics too. We're going to expand out this performance, but we do the big ones right away, like return, win rate, profit factor. Like we want you to see what your bots are doing if you forward walk and paper trade them moving forward. Right? You can run a strategy and then paper trade it, or if it's a new strategy, paper trade it and track the performance of those moving forward. In this particular one, again, the 3% of capital it was just a loser. It didn't work out well. If you were going to do this and you wanted to deliberately lose money, this is how you would do it. You would do it with 1%, not 3%. Right? Pretty cool. So let's go back to the back tester. This is our Iron Condor that just finished running. So I can load up that strategy. And here's what happened right here. Effectively, the blue and the green one, the blue and the green ones are exactly the same. It never had a chance to over allocate, so they just overlapped each other. But notice that this strategy, look, if you're a beginner trader, what strategy do you want to try right away? Like this strategy has data from 2007 that is a pretty good, consistent, nice moving P&L line. Is that the type of strategy you want to at least focus your attention on? Or do you want to focus on the long call, super hot shot, you might make $1,000, you might blow up your account type of thing? This started with 10 grand. And I think that the $700 per position is probably a more stable metric to track after. So let's look at the performance. And again, look, you can see the $700 capital at risk, it always had a low capital at risk. So even though you had a big portfolio, it really wasn't allocating a lot of capital. Clearly, because it's just keeping it at about $700 per trade. Steady, consistent, day in, day out, long term. The 5% of your account, as your account grew, it allocated more, which means that it got a little bit more squirrely. You know, like it went through a drawdown because it was now very, very valuable, but it basically rocked it back to earth. So let's look at the performance metrics. Is this stuff cool? Do you guys love this? This is the coolest thing that you can do this. I'm going to show you how you can tweak it real quick here in a second. You're going to freak out. So the 5% of allocation now did pretty good. 5% of your account. The rest sitting in cash did a 9% return over the totality of the strategy. Now look, this is where I say that the totality of things that you look at and the long-term perspective is so important here. Because if you just ran this strategy for the last, say, 4 or 5 years, from 2017 to now, it looks like a loser. And for that period, it was. But if you microscopically look at things in such a short time period versus looking for broad parameter stability, you would have completely missed what a great strategy this is. The profit factor is above 1. The drawdown seems pretty reasonable. You had a pretty high win rate. You did have a pretty decent worse loss, right? And your days in the trade were about 45 days. So remember, when we set up this test, we were going out, I think it was 60 days. We're going out 60 days and we were exiting 10 days. So we even stayed in the trade about 5 days less than expected. Maybe some of the trades hit a profit pretty quick. By the way, the new backtester is updated, I believe it's monthly with new data. So like the new data that'll come in is about a month or so lag, and then we update it ongoing with new data. So notice we have the market crash in here from this year that you can start testing off of. Is that pretty cool? That's 5% of allocation. I'm more concerned with this one, which was the $700 per position. To me, that looks like a more stable one. Profit factor was a little bit better. Drawdown dramatically less. Half of the drawdown. About the same win rate. Your worst loss was dramatically lower. You were in the trade about the same number of days. I mean, look, that right there is a solid strategy to start with. Who likes the green one? Who likes the orange one? This is just my opinion. I like the orange one better. But like, which one do you guys like? Let me switch over and share my screen real quick on this. But if you understand how powerful that just was, I'll jump back in there and do it again. And we'll continue to do this. Take that strategy right there in like the Otis framework like this. Take that strategy that you just figured out here and now implement it on $700 at a time. Take the strategy, now tactically implement it with automation, then go find another one. Go find another one. Right? So let's do this. Let's try to break it a little bit. So instead of 5% per position, let's change this to, let's do this. Let's change this one to 10% per position. And let's change this one to, let's double it to $1,400. $1,400 per position. What the cool thing is that you can actually change these dynamically and then just rerun the exact same test right over. So now you can change these and pull up all the new data on the test. And there it is. There's your new, oh crap, I didn't share my screen. I'm here. There we go. There's your new test. All I did, by the way, is I went in here to capital and I changed these to 5%, 10%, and 1,400 per position. And then I just reran the test. And now I get brand new data. So now I can start to manipulate the test itself, and I can start to really stress test this to see where the end is for me when I want to use this strategy. Maybe I can push the envelope a little bit, and I can, like, I know what 5% of capital did. That was this line here. Remember that line looked really, really crazy? And everyone said $700? I don't know. $1,400 per position actually did significantly better. Right? Then you look at 10%. 10% started to get a little crazy. Because at 10%, you had a good profit factor, you had a great return, you crushed it on a CAGR, like your compound growth rate just went bananas. But what happens is that the strategy really took off, and right before the crash this year, it had a real big allocation. Really big allocation. And then it just crashed, right? So somebody asked a question here, which was good. Like, how come the new test didn't take the same amount of time? Because the actual trade data was already pulled. When you manipulate just the allocations, that trade data has been collected, and we can rerun the test faster when you only change the allocations. So you can play around with those allocations real fast. Is that pretty cool? Yeah, so you just change the allocation right in here. You go to your capital. You say, you know what? Here, let's do it right now, right? 10% seems a little obnoxious. Would you guys agree? I mean, maybe some of you are like, nope, I get it. But like, if you did 10%, you went through a 60% drawdown. I'm pretty sure if any of you traded this, and like, let's say you were following a bot that I didn't traded this, you would all kill me. I mean, you'd all be pissed at me. You'd be like, oh my God, a 60% drawdown. It's probably too much, right? Still had a good win rate, still had a good profit factor. Just the drawdowns were just way too much. But let's just manipulate just that one real quick. So let's change this from 10%. Let's do something like 7%. And let's change this from $1,400. Let's just keep pushing this a little bit higher. Let's do $2,000. That's probably a lot already. But let's see what it would do. Now I just did that. And so I can just go in here, just rerun it. Okay. Now here's 7%. So now we got $2,000 per position. Still pretty stable. Still pretty stable. Your $2,000 per position still had a small drawdown. So do you guys see how you can kind of push the envelope a little bit with it and find where those breaking points are? Right in here. 5% looks a lot more stable compared to these two. Definitely compared to $7,000 per, or 7% per position. Yeah, I think this is going to be the good discussion. You guys are having good discussions even right in here, where you're saying to yourselves too, like, it seems like the money, it's better to allocate based on, you know, fixed dollar amount as opposed to this. In some cases, yes. In some cases, no. Thomas, I think you're right too, right? Like, this is good. This is, by the way, can I tell you guys, this warms my heart like you don't even, like, you don't understand. This type of discussion is exactly the type of discussion that we all should be having with each other, that we can now have when we share bots and templates back and forth in the platform, because this is how we help each other. All that other garbage talk around stuff, like, this is the type of stuff that helps, where we say, hey, I found this. This is how I can help you, man. Like, God, that's what we need. Like, this whole industry has been missing that for so long. Is that cool? So here's how I would think about this. Let me give you the next level of this so you can keep going on this, okay? When I look at this graph and then I see major drawdowns during black swans for all of these strategies, I start to think about how I can implement this strategy and start to maybe overlay some other indicator that could have avoided or turned off the strategy at that time. Right? I start to overlay the idea that maybe if I used just a simple trend indicator, how could that improve the performance of the strategy? Would it have gotten me out before that crash? I don't know. We don't have the ability to test it right now. But that's some of the stuff that you can start to filter and add to your bots and start to, start to think about. Your brain power and your mind is so good at doing this type of work versus the mundane activity of trading. Because all of this that we have in here can be built into a bot. And by the way, one of the items on our to-do list in the future is to one-click turn a strategy into a bot. That's one of the items on the to-do list. And another item on the to-do list is to combine and run grouped portfolio backtesting. So you'd be able to select this strategy across a basket of different tickers, and then test the combination of different strategies together. That's where we're going in the future with this. Right now, we're just rolling out, which is great and helps you out for sure, the ability to run one test at a time. One ticker, one test at a time. But the next iteration of this is clicking on all of these and selecting 5 or 6 different tickers, and then being able to run a backtest of a whole portfolio. How cool is that going to be? I mean, all this helps right now. This definitely improves your performance as a trader if you have this data and this ability at your fingertips. You want to see some other ones? Here's a DIA, Iron Butterfly. Again, some running of some different capital allocations. This one, a lot more choppy than IWM. Considerably more choppy. But we were also trading a more aggressive strategy. 50 delta at the front, long delta on the back. I did max this out at 70 IV rank. I was just testing it out. Like, what if we avoided high implied volatility times? Right? What if we avoided high implied volatility times? How would that work? And then you can see the performance of these different, the different allocations. I think all this is so fascinating. The one that I particularly found very interesting was, I believe it was this one. Yeah, it was this one right here. So this is a weekly short call on SPY. 3 different allocations. We're selling a 15 delta short call, 60 days out, no IV filter, never taking profits, and letting it run to expiration. Essentially, 2 days before. The reason I think this one is fascinating is because the 5% capital one had a very nice profit factor, an insanely good win rate, almost no drawdown, and lots of trades. Now, just hear me on this for a second. I want you to really hopefully open up your mind to the possibility of finding strategies, gems, little things that you can do like this. This strategy by itself was not a money maker. Was not a money maker. It didn't make a ton of money that you could write a book about and be like, this is the end all be all strategy. But because it's a short call strategy and it had a great profit factor, high win rate, low drawdown, this is a strategy now that I can deploy using a bot, and it might help reduce the sting of strategies that fail when markets go down. Does that make sense? Because this is a short call, it's going to profit when markets go down, when markets stay sideways or fade lower. So it may not be by itself a great strategy, but when I combine it with another strategy like the IWM one that got rocked when the markets tanked, maybe I don't lose as much with the combination of those two together. Do you see how you can use every bit of information from backtesting? And you don't need to look at it in such a microscopic lens of, oh, this one didn't work, it's not good. No, wait a second. This one's 5% of my account with an 80% win rate, a high profit factor, and lots of trades. That is something I don't get excited about. I don't get excited about coming in and trading this, but now I can trade it using automation and add it to my portfolio. I can take this strategy now that I found, I can add it to Otis. I've strategically found this. I can automate it and put it into a tactical implementation phase. And then I can come back over here and find more strategies. Because it reduces the volatility of my whole portfolio by having it included in there. Right? Is that cool? Like, I don't know. I geek out about all that stuff. That's stuff that I hope you guys geek out about too. I think most people in here do. But man, like that addition to your portfolio, if you just think about the overlap of some of these things, that's fascinating. Here's another one I discovered in here. I discovered this on the demo. Like, I didn't even know this was the case. Most consecutive wins. This is a strategy somebody else ran that had the most consecutive wins. Okay, I got to highlight this comment because it is exactly what I was saying, and I didn't even say it. Thank you, Thomas, man. Using backtesting to identify strategies that serve as your rear spoiler, brakes, gas pedals. Exactly. That's exactly right. By itself, you look at it and you go, it's not too good. But when you add it to a race car, you go, wow, that helps reduce the volatility of everything. And I'm not giving up much for it. The drawdown was low. That's a great ad. Great comment ad. So this one is a SPY monthly short put spread. So if you just look at the edits, you can see what they did. They sold the 15 delta, bought the 5 delta, 90 days out, no IV filtering, and they took 25% profits. That's it. So close at expiration or take 25% profits. By the way, very easy strategy to put into a bot. Super easy. Too easy. The strategy crushed it except for when the market was in a downtrend. Again, I beg to ask the question. If you can now look at this and intuitively start thinking to yourself, okay, this strategy would be great when you can have the bots check market trend. Have the bot check for market trend and avoid any downtrending markets. Right? But look at this one. It had 251 trades, a 98% win rate, a crazy good profit factor, and 217 winning trades in a row. Now, we don't know if it's going to do that again moving forward, but when we look at the totality of the trade, and it made a lot of trades, do we have some reasonable assumptions that the parameter stability here is probably there? Yeah. Yeah, we do. Do you know what this didn't do, by the way? This one's always a fun one to me. Do you know what this didn't filter out? It didn't filter out tweets, presidential things, Supreme Court hearings, Fed statements, policy decisions, this, that, whatever. It didn't filter out any of those crazy things that we think don't impact our trading, but we know that they do when we trade. This thing was just very regimented, religious, consistent. And guess what? It was only 5% of your account. Do you think you could spare 5% in your account to spin up a strategy like this and start trading it? And then overlay just a very simple trend decision so that the bot stops entering this strategy when the market is in a downtrend and then restarts it when the market's in an uptrend? So good, right? Like all of this stuff is so powerful to use. Biggest winning trade. Here's one that had the biggest winning trade of anything. 10% of my account at any one time? Probably too much for me. 30% drawdown, decent win rate, lots of trades, high profit factor. Okay, let's explore it, right? Let's see what it was doing. It was doing a long call spread. Short delta at 10, long delta at 40, 10 days from expiration. This was a position that is a short duration position. A lot of people would avoid this now and say, oh, I can't do that anymore because I'm a long-term trader, or I'm a medium-term trader, or I'm a whatever. But now you can do it if you don't have the time to manage this because you can let a bot manage it for you. So maybe you don't do 10%. Maybe you do 3 or 4, right? You manipulate it and you start to run different tests to see what else you could do with the strategy. What else do we do here? TLT Iron Butterfly. Oh, this one just did not do well. 5% of capital just got annihilated. 1% of capital didn't do pretty well. But what it did do well is it was pretty stable. So you get a benefit from diversification potentially for TLT. And I would agree with that. Is this the right home strategy? No. Is it pretty stable? Yeah. Even through the market crash, it was pretty stable. At least the 1% of allocation. So do you give it a 1% in your account? Maybe. You be the judge of that. Can you figure out a different way to allocate capital that might have worked? Maybe. Or do you do it differently? Let me see if I ran it differently. Yeah, this one I think I ran a little bit differently too. I was messing around with it. Do I do a short 50, long 5? Do I know? Oh, this was no profit taking. Just let it run to expiration for that particular position. It's pretty fascinating. Okay, is this helpful to you guys to go see all of these? Apple short put. I think it ran out of capital to be able to do it. It's pretty fun, right? I mean, it really is. Like, I think now look at this. This strategy is kind of crazy. This strategy went through literally an upcycle and a down cycle, right? Literally an upcycle and a down cycle. Came out of a down cycle. So it just could be a strategy that cycles through. Or maybe we just had too much capital allocated to it. So try something different. So do this. Do 1% allocation. Let's do $1,000 per trade. No, let's do $2,000 per trade. And let's do $5,000 a trade. Just to see. I don't even know. I'm curious how it would perform. Okay, well, at least we skewed the charts a little bit higher. The 1% of capital did effectively nothing. $5,000 was quite all over the map. $2,000 a position. Again, very much a neutral position. You didn't really do much. Lots of trades, about 50-50 win rate, about even profit factor. You went through a decent drawdown. It seems like you could manipulate and try to find something a little bit better, or at least mess with the allocations and the deltas and the profit taking a little bit more, right? Maybe you took profits too late. You need to try something different. This is what you should be focusing and spending your time on, doing stuff like this and research, so that it allows you to get the biggest bang for your buck for your time that you have during the day. Because all of this stuff through the bots, this can all be automated. Once you find something that you like, just automate it. Just let it automatically trade for you. Let it go through all of the different trades and make all those decisions for you automated. You don't need to spend your time going through. This thing made 600 decisions for us today. I don't need to make 600 decisions. This one made 1,000 decisions today. I don't need to make 1,000 decisions. My time should be focused on this side of it. Strategic. Implementation side is covered now. Covered. That makes sense? Blake had a good question. How do you avoid succumbing to data mining? I think you just have to be aware that it exists. That's the first thing. You can manipulate a lot of data. If you have a lot of data, you can manipulate to find the best, the best, the best. That's why I said I think you take the strategies that do the best and then try to make sure that they do the best across a broad parameter of tickers. Like rerun the strategy over and over and over again. Combine them with different strategies. And I think it works in the opposite, where people don't find the strategies that do well when combined into a portfolio. The rear spoilers, the short call in our example today. That strategy did really well if you add it to a portfolio. By itself, it's a dud. Does that help out? Any questions on anything today? We're going to wrap it up here in a couple minutes, but did you guys enjoy this? Was this helpful in thinking about the process, finding trade ideas, thinking about how you find those ideas, positive expected outcome, you know, that combination of win rate, drawdown, profit factor type stuff? If it was helpful, please, please, please let me know. Please, please, please let me know. Data mining is just the process of putting together a bunch of data and always finding the best thing that just could have randomly happened at the end of that cycle or that particular data set. Raises my thought level, very helpful. Yes. Mine was blown, very inspirational. Awesome. Very helpful. Yes, thank you, thank you. Awesome. Thanks, Doug. Extremely helpful. Good. So tomorrow, what we're going to be doing, going through this, by the way, is we're going to be spending most of our time tomorrow on building bots, going through to the decision tree, thinking about automations and how we can fit and formulate those all together. That's really the big part tomorrow, is individual bots. So a lot of what we did today, this is where I think most of your time is going to be spent anyway, which is why I wanted to start with this. Tomorrow when we start again, it's 1 p.m. Eastern time. Tomorrow when we start again, the focus for tomorrow is going to be on building bots, how we can use all the different things and tools inside of it. And again, it's just the beginning. This is all just the beginning of rolling out this new platform. You guys have so many amazing ideas and things that we continue to add and develop and Things like smart pricing you'll get access to soon, and I can't wait to see where this goes, truly. So tomorrow, 1 p.m. Eastern time till, well, we give ourselves till 5 p.m. Eastern time. We'll see if we actually need all the time for this, but I just want to try to build out as many different bots and bot ideas and kind of really go through bots as slowly and as meticulously as they deserve their time for. Okay? If you guys have any follow-up questions, shoot us an email, team@OptionAlpha. That's the best place for it. If you guys enjoyed this today and you thought it was helpful, please share it. Share it, give us a upvote, like, whatever. Like, get this into the hands of other people who potentially need this and might get something out of this. And then finally, I would encourage you guys, and I hope that you do, join us at the Elite Lifetime level. There's only a couple days left for this. On Saturday, the 31st at midnight, when we cross over from midnight on the 31st until November 1st, so at midnight on the 31st, Halloween, that is the last time to join Elite Lifetime at this current price. Then the price goes up. So I would encourage you guys to take a look at it, get all your questions answered. The coolest thing about this whole thing for us is that if you don't see something in there now, that doesn't mean that we can't start to build it out. You guys have such creative minds, and I know where all of this is going, and I know all of the ideas that you have, because if we show you one thing, you're like, oh, we got to do one more thing, right? And I know that. That's why we're just going to continue to build this out for you and just continue to improve and enhance and update the new platform for you. So head on over to optionalpha.com/lifetime. That's where you want to get it, optionalpha.com/lifetime. If you want to learn more about the new auto trading platform, beta.optionalpha.com. If you want to join me on a demo, which we're going to do a demo effectively tomorrow and Thursday, and a full demo Thursday night, just essentially I'm just a glutton for punishment, and I just want to sit on the webinar with you guys all day, every day. Thursday is going to be essentially me streaming live from 1 till whenever in the evening I feel like. So excited for you guys to be in there. I can't wait to get this platform into your guys' hands. We're going to start rolling out access here in the next week or so. We're just going to get all of our data feeds in place and get it all up to date and get all our compliance stuff in, and then we'll start rolling it out. So thank you guys for those of you who have been members. I know some of you that are in here have been. Steve is like already member. Signed up, awesome. Blake signed up and he's ready to go, awesome. Worth it for the shirt alone, signed up. Feel like a smart guy being in the room. Baron, you're there, man. You've been a member for a while. Thanks, man. Appreciate it. All right, thank you guys. I'm going to wrap it up there. Have a great rest of your Wednesday afternoon, evening. Thank you so much for being here and spending time with me. If you spent the whole time with me, you guys are the bomb. Thank you so much. I really, really do appreciate it. Means the world to us that you guys spend your time with us. So we don't take that lightly. I sure don't. Thank you to my team for being here. Rocco, Rob, Mike for helping out and for supporting what we do here and just helping out in chat. I know you guys helped out everybody in chat today, so you guys can say thank you to Rob and Rocco in here who've been gracious enough to spend their time in here as well. So thank you guys so much for being here, and we'll talk to you guys soon. Take care.